You know, it's not the movies.
Well,
things get out of the way.
There's a belief that there is a window of time for Ukraine to really make inroads before the spring, that the weather could be on their side and all of these things. The issue that I have is the war is still going on and the tail risks are still there. And this is really a huge effort on all sides to figure out how to grapple with it.
We see that with the euro this morning. Really stasis here at a 109 on euro. Futures deteriorate down a good 0.8%, negative 30. NASDAQ futures negative 1.2%. Stay with us. Mr. Farrow in London with Jane Foley. Look for that. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and Germany have overcome a disagreement that threatened to fracture Allied unity. They've agreed to give their main battle tanks to Ukraine. Germany confirmed today that it will send 14 of its Leopard tanks to Ukraine, and eventually there will be more. And as you just heard, they will be sent out, deployed to Ukraine in about 3 months. Meanwhile, the Biden administration expected to announce as soon as today that it will offer Ukraine the M1 Abrams tank. In China, Lunar New Year travel and movie box offices are showing signs of recovery. In the first 4 days of the holiday, the number of trips was up over last year. Meanwhile, the number of movie tickets sold was higher than in 2019 before the pandemic. The Bank of England has headed off threat of a strike. It's agreed on a 3.5% pay hike for its 4,200 workers. The increase in the overall pay pot will be targeted at lower paid staff to protect them against the worst of the inflation squeeze. Google says the U.S. Justice Department is doubling down on a flawed argument by suing the company on antitrust grounds. Now, 8 states joined the federal government in calling for the breakup of the search giant's ad technology business. The suit claims Google has illegally monopolized the digital ad market. And one of the world's largest chip makers, Texas Instruments, has suffered its first sales decline since 2020. The company also gave a lukewarm forecast for the current quarter. Texas Instruments has the longest list of customers and broadest range of products in the industry, and that makes its projections an indicator of demand. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnsons, more Michael Jordan, more Magic Johnsons, and Oprah Winfrey's and the like.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Most large corporations plan out their hiring and headcount a year, 2 years, 3 years in advance, and every year they then adjust. And I think what's happening is the weakness really became more pronounced And concerns about corporate margins became more pronounced in the fourth quarter, right in the middle of that planning process. If you look at CEO confidence in the economy 6 months out, it's at an all-time low.
Joe Mattis, thank you so much with MetLife. Great to see Mr. Mattis yesterday. I thought he was very good about some of the optimistic trends that are out there. And again, it's a morning data check that suggests economic slowdown here. The yield space is really important. 4.15% yields coming in lower on the 2-year space. The 10-year was a 350. We're in all over 2 days, 7 basis points there for 3.43%. 2s, 10s gave me some major inversion yesterday afternoon. We come back a little bit, still a very large inversion, 72 basis points. And my headline is the inflation-adjusted 10-year yield just flat out grinds into a new lower real yield. John Farrow in London, Jane Foley to come up with him on foreign exchange, Lisa Bramwitz and Tom Keene here. And I want you to grab, whatever you're having. I'm having a Tang-free morning for those of you on radio. It's in a beautiful crystal clear cup. But you got to have your coffee because we're going to bore you to death right now. There's my Tang-free. And joining us is Senior Vice President, boring us to death, Mandeep Singh of Bloomberg Intelligence, who's truly excellent on when Washington decides tech is too big. He joins us this morning on a 150-page document that I was thunderstruck by. Mandeep, I'm not going to mince words. I go back to April 13th, 2007, just before the great financial crisis, where I fell off my chair when Google bought the ad business by buying DoubleClick. Take us back to 2007. What did Google wrought when they bought DoubleClick?
Well, basically, they integrated their product suite across the stack. So think of ad market as, supply-side platforms, demand-side platforms, and then you have an ad exchange in the middle. Google has products across the stack. And pretty much if you want to advertise on any of the Google properties, whether it's search, YouTube, maps, etc., your best bet is to use a Google ad exchange because that's how you are going to get the best, most targeted ads. And that's what the Department of Justice is laying out here in a very clear way, how they have used that acquisition. And look, they've added more products, more tuck-ins to kind of solidify that because that acquisition was geared towards the web era. Then you had the mobile era. And so Google consolidated that. But essentially, the case that they're making is why does Google need to be an ad exchange when they are one of the biggest publishers out there and they are one of the biggest demand-side platforms out there?
On a day of AT&T earnings, is this equivalent to a request to do a Ma Bell and do the breakup into 9X, Pac Bell, and the rest of it? I mean, is that all we're talking about? Is Google says, okay, we're too big, we're going to divest, and of course they take a huge equity interest in DDM.
Well, so it's not that simple. With internet businesses, and again, I'm going to mention network effects and scale. It's all about that. And the way you get it is, by integrating things across the stack. I mean, even, Apple, that's what they've done for their App Store and how it integrates so closely with their hardware. So essentially, you could argue that the ad exchange piece can be divested. But I don't think it's that simple in terms of taking out a product and spinning out a separate company. There is a lot more nuance to it, and that's where it'll be challenged.
Lisa, are you dozing off yet?
No, actually, I think that this is actually a really fascinating issue because if you take a step back, at a time when we're getting technology earnings, we're hearing from the Department of Justice, which doesn't want to just fine Google, just slap them on the wrist. They want to have them do a divestiture of a major business model. Where is the growth going to come from in the technology sphere, given that the Department of Justice seems a bit more concerned about antitrust issues at this point?
Yeah, so Lisa, I think even in the call last night from Microsoft, cloud continues, especially the infrastructure side, continues to grow very well, 30% plus growth. Yes, it's going to decelerate a little bit from, above 35% to low 30s, but it's still very strong. And if there is any resilient piece in the IT spend, that's the one I think every company is targeting, even Google for that matter. They're trying to build their cloud business, and that's where you're going to see companies continue to spend on AI, and all these trends are feeding into that cloud infrastructure spend.
Given that, Mandeep, can you give us a sense of what your takeaway yesterday was from Microsoft's warning of some softening growth in the Azure, in the cloud computing unit, and what to expect from Intel, what to expect from IBM, what to expect from some of the other tech giants that are set to report earnings the next few days?
Yes, a pretty bad read-through for the PC market. I mean, Windows OEM revenue was down 40%. So if that's any indicator, we're not in for a quick rebound. At least that's the read-through from the consumer side, the PC side of Microsoft's results. And the Azure deceleration, I still think they're a little bit conservative in their guide. They have tough comparisons. That's what makes it tough to keep growing, 40% plus, but it's still the resilient piece. The productivity apps is coming down because you're seeing these tech layoffs, and it's a user subscription driven model. So that's where you will see some deceleration. But look, Microsoft is still indispensable to enterprise IT. And, if they are seeing a slowdown, that will have a read through for pretty much all the software vendors out there.
Right. Mandeep, let's go back to United States of America v. Microsoft Corporation. I was sitting somewhere here at Fortress Bloomberg, and all of a sudden they dropped the litigation, the effort to break up or rip apart or tear apart Microsoft. Why is this any different? They're going to go on for 2 years, 3 years, 5 years, dare I say a decade, and then in exhaustion, one form of new political Washington's going to walk away from going after Alphabet A to Z.
It could very well happen, Tom. And look, this is not new. Google has been fined multiple times. I think what it kind of creates a situation for Google is, one, they can't make any new acquisitions, and they have to sort of create a level playing field. They're trying to do that with the deprecation of cookies, even on their Android ecosystem. They're trying to make sure that every ad tech platform has a fair chance in terms of bidding for the ads on their platform. And those are the kind of things, the remedies, that is what you're going to get
remedies?
out of it,
We need a lawsuit. We need United States of America against Apple, and they need to remedy the fact that within 3 weeks, you always lose one of your AirPod thingies. That would help more. Mandeep Singh, thank you for the clinic there on Google. This is a raging debate. Lisa, you and I don't agree on this. You think this is a big deal. I think it's just comical nuisance against the jewels of America, which is our technical superiority versus the rest of the world.
There's a question about whether you're crimping, and it is really truly a debate, crimping innovation with tech giants hoovering up all of these small competitors before they did
when
really
they hoovered up DoubleClick
but that's
in 2007.
Exactly, right.
That's what they did.
That's exactly the issue. And so if the Department of Justice wants to stop that, these sort of cash cows to be able to go in and just sort of take anyone who's a competitor in order to foster innovation, does it foster innovation? Does that indicate that there's going to be a different kind of spending? There is a bigger significance to this, especially at a time where this is one of the questions. Where's the growth going to come from going forward?
I'm going to do a compare and contrast here, which I think is really, really important. Brian Moynihan at Bank of America, in any conversation, he's a true banking nerd, lines up what Bank of America is doing with their cajillions of profits to help the cities, the towns, the programs across this nation of a huge part of this nation flat on their back. I don't see tech doing that. That, to me, is the heart of the matter.
That's a great point. Because
not only,
actually, I think that's an excellent point, because if you talk with the bankers, they're investing, how many billions of dollars in issues with climate change and other issues that, you can be cynical all you want. It is to try to create a better impression after a really negative impression of the banking sector for a number of years. Is tech going to be required to do some similar types of investments?
They don't want to.
Some similar types of PR outreaches.
They're not going to make PR outreaches to that. They don't want to do it.
Whether they want to or not.
They're special and different out in Silicon Valley.
Until the DOJ starts going after them. Until suddenly you start to get fines. Until suddenly you have to have more of a lobbying effort. And that really, you actually raise a really good question. Are they going to have to put more muscle into that?
Where the hell's Pharaoh to sit between us and adjudicate these matters?
He's going to sit like on a stool right here. I think he's very happily not shaving and waking up at 6 a.m.
What do you think? I'm getting a lot of mail.
No, you're not. You're absolutely not getting a lot of mail. What, people want you to have a beard?
They say go full wolf.
How long would it take you to grow a full wolf?
a man like me, 2-3 days, something like that. Folks, I didn't shave 5 days a week until I was like 43 or something. That was great. Mandeep saying we're never going to do that again. Thank you so much with Bloomberg Intelligence. Futures at -34. Should you be in the stock market? Next, Binky Chadha.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies, and I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, went from 5,000 to 45,000, I would be wiped out on the short side. So it's just too volatile to short.
News breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We're seeing upside surprises in the data.
The thing that we don't have is global growth.
You need to be data dependent. You need to see whether these dynamics actually play out.
The idea that this is all behind us in the economy, I don't think that's true at all.
It's far too early to say that recessions won't happen as a general rule. I think actually all the pain is probably still to come.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, John Farrow in London. We'll go to him in a moment here. Lisa Abramowitz and Tom Keene in New York. Economic contraction is out there. We are going to push against that here in a number of minutes. For those of you optimistic, for those of you that say, over my dead body, Binky Chadha will be with us here in a moment. And Lisa, to frame this out, some real caution on the screen this morning.
Well, caution in the earnings, and I think the earnings this week are the highlight as people get a sense of what's actually going on the ground. The big debate that I keep hearing is, what's priced in and what's not, right? Microsoft coming out, better than expected earnings, the look ahead, a little bit disappointing.
Well, that's Microsoft, and then the others will come out. But to what you and I talked about yesterday with Minnesota mining, it's away from the names that we all love and follow, and I'm really interested in how industrial America reacts. Julian Emanuel had a really important point. Now, excuse me, it was Tyler Radke at Citigroup, where he said Microsoft is doing what you do. You cut your operating expenses. You cut your CapEx down in a time of stress.
Microsoft is one example, and that's among the big tech behemoths. But the 3Ms of the world cutting 2,500 people, the idea that you're getting, it's a very different kind of comparison that's a little bit perhaps more hinged to the real economy.
I look at the markets here, and the big change for me this morning is a real bet on a disinflation. The 2-year yield in 4.15%, down substantially. We're not on the 3.99 watch yet, but we're getting there. What's a signal to you, Lisa?
A lot of people are looking at the real inflation right now and saying it's already fallen to 2%. If you take a look at December inflation, and there's a huge raging debate, does it matter? I mean, 1 month doesn't make a trend, right? 3 months might be the real issue. And that's why I'm really curious about Australia and the wage inflation and the fact that inflation accelerated in the last 3 months of last year, pushing against some of this past peak inflation. It's over. Go home. You're good.
Go home. We need reporting on this, and we're going to do that Friday evening, Manchester City against Arsenal. John Farrell will be reporting for us Friday evening and joins us right now. Is Man City the only company that can beat Arsenal? I mean, that's what this reporting's about.
Are you suggesting, Tom, that's why I'm here?
No, it's just set of games you're there.
City Arsenal.
Yeah. That's going to be
I'll tell you what I'm interested in right now, Tom.
Please.
It's not the football, it's the data. It's the economic data relative to expectations and relative to different places. So let's start with the United States. If you look at the economic data relative to expectations, the surprise index starting to roll over. Compare that to Europe, starting to inflect higher even more so. And that trend in Europe actually started last summer. So Tom, when you push that through the market, think about foreign exchange for obvious reasons. Look at the bond market too. Take the German 10-year US spread. Look at the gap starting to close. And I think that's my question for 2023. To what degree, to what extent can we close that gap even more? The ECB hiking interest rates last year, Tom, to 250. The Fed gets to 450. The ECB this year expected to play catch up.
But I'm seeing different series, including the real yield, John. You'll remember that program. I look at the real yield coming in, and the bottom line to me is this an economic slowness, not contraction, but slowness, that forces the attention of the central banks? To me, that's the February question.
It forces the attention of the Federal Reserve. Right now, I think the question of January at the moment, Tom, is just a green light for this ECB to keep on hiking. We got that from German business confidence this morning. My question, TK, and I keep going back to it. I asked Max Kettner about this about an hour ago on this program. Are there durable tailwinds to this Europe story? Is this just about a positive surprise, a readjustment in the probability that they go into recession, and then what? And the then what is pretty interesting. There's a big difference, Tom, between recession and stagnation and recovery. So we've parked recession, we're talking about stagnation. Now compare stagnation with the prospect of a real expansion in Europe. I don't think anyone's looking for the latter just yet.
Yeah, I totally agree with that on the expansion in Europe. It's just, we got to wait to see the data on that. John Farrell with Jane Foley here in a bit will be an important conversation on foreign exchange. On foreign exchange, I got churned to the market here with the euro 109. Yen really off the radar after the follies of the last 10 days at 129.74 yen. Sterling, Farrell at a 123 it's enough to get him to Manchester City on Friday. It's going to be, seriously, that's going to be an exceptional game. Tell me about what we got in the brief.
Just real quick here, 10 a.m. we get the Bank of Canada rate decision. Curious because they tend to be a front runner of what happens at both the Bank of England as well as the Federal Reserve. 1 p.m. we get the U.S. selling $43 billion of 5-year notes. Yesterday's demand for 2-year notes, very strong. Do we get the same for 5 years?
Going to come in.
It's people who want to own this debt because they think it is of value with the yields where they are. So this, to me, is a fascinating moment, considering that a lot of people are saying the Fed's going to push back against the market expectations. And earnings very much in focus for me. Tesla and IBM after the bell. We have Dan Ives saying that the Tesla earnings will be the Super Bowl of the earnings season. We have Microsoft shares lower and continuing to inflect lower throughout the morning, down 2.8% after disappointing guidance. And we heard there from Andeep Singh that perhaps they're being overly conservative about their expectations of growth in their cloud computing business, but showing the importance of that Azure platform of cloud computing in general for big tech.
Let's get to it. If you're in Global Wall Street, this is without question your interview of the day. If you need to be optimistic, there's no better place to be than at Deutsche Bank with their chief global strategist and head of asset allocation, Vikram Chadha. Mr. Chadha has made clear he is enthusiastic, and as it hasn't happened, he's simply moved his timeline out. We get an update this morning from Binky Chadha. Binky, you're at 4,500, 4,400, 4,600. Nobody believes you. You've never been this lonely in your storied career. Give us the x-axis. When's the timeline when Chadha Nirvana happens?
So actually what we have in terms of our outlook for this year is really the rally in Q1, which we think of as basically a continuation of the rally that began late last year. I wouldn't necessarily describe it as, sort of a bullish view on fundamentals. The basic driver of the rally, in our view, is really a positioning squeeze. As we know, since late April of last year, it's all really been about the central banks. And if you look at our measures of positioning, the fundamental investors, we call them the discretionary equity investors, very quickly moved down to neutral to slightly negative. What got squeezed as a result of the last 6 months of last year is really systematic strategies. Systematic strategies tend to follow the market. So to have this big divide between systematic strategies, 2 Z-scores below neutral, let alone where they most of the time...
I flunked that on the CFA exam. Binky, let me cut to the chase. Ralph Ankapour in technical analysis is adamant we made an October low in the Dow Jones Industrial Average. He's as bullish as you are. So there's a short squeeze. We're squeezing out the gloom. I get that.
Yeah.
What's the then what after we squeeze out the gloom for you and Mr. Ankapour?
So, we have our year-end target, which, yes, I understand it looks bullish. I would say it's only a little bit more than 10% up from where we've been recently. We see most of that happening basically in Q1. And then we have basically, as you know, a call for a recession in the U.S. Starting in Q3. So second quarter, keeping in line with the recession playbook historically. We have the market going sideways, so that's still 4,500. We have, if the recession happens in Q3, a pretty severe sell-off, which would take us all the way down to 3,250. But I think, very important aspect of the recession playbook to keep in mind if you're thinking out 12 months is that equities, pretty robustly bottom about halfway through. So if we have a 2-quarter recession, they will come all the way back basically in Q4. And so my Q1 target is my year-end target. Yeah.
You said something pretty radical, that it's all been about the Fed. It is not necessarily about some of these other issues, like earnings, which we keep getting and a lot of people keep looking at.
Sure.
So how do you push back against that? And how much do you expect tech to continue to lead, regardless of the up or the down, because of that macro play?
Yeah, so tactically, our call is to be, the rally will be led by tech and the financials and some of the consumer cyclicals where, priced in 120% of an average recession. I think it starts to make things pretty asymmetric. I'm sorry, I lost the last part of the question.
No, but this is an issue because right now we're looking to...
I do the same thing. Don't say you're sorry.
What, just because of me? No, this is an interesting issue because right now I'm watching earnings and people are saying there's a real fundamental shift underneath the market, that you have tech that's not necessarily going to lead in growth, even though they now are leading in returns just simply because of cuts, et cetera. And I'm wondering whether you see that, whether we're heading back to a different normal in terms of leadership or whether we're heading back to the same regime. It's just sort of dependent on the Fed.
So, in terms of earnings, for the year as a whole, if you put in a recession in there like we have, we're talking about $195. So the question is, what happens if the alternative, which is a very popular question given the market price action, and it's more likely to go sideways and even to start to recover. I think in terms of thinking about earnings, everybody talks always about growth rates. I think it's also important to keep in mind where the levels are. Equity valuations come off of levels. And earnings have been running, sort of well above trend levels. And so, we have this issue where, I mean, even if you looked at real activity, the good side of the economy, it's essentially been going sideways for 2 years now.
We're out of time, Binky, at 4,500 on SPX. And what Mr. Chadha just said there, Lisa, is religion to me. which is it financial TV is addicted to change, movement, stay with us. Microsoft right now down under 236, that kind of stuff. He's looking at levels. And this is the bathtub story. You're looking at the water coming in and out of the bathtub, or you're looking at the level. Olivier Blanchard in his new monograph is on the same page in economics as Bikram Chadha in equities. Levels matter. The levels, the scale, the mass of Microsoft matters.
Yeah, and that's the reason why you have a real battle right now of how disappointing some of the guidance was, or was it not at all? They're still seeing a lot of growth. They're still rolling off cash at a time when, this is still something that gives them a lot of power.
I mean, it's outrageous. We've got a modeled out 12 months Microsoft free cash flow of 75
I know.
billion,
I mean, this is
$75,000 million.
They don't do that anymore. People messaged me and said, please correct TK. We don't say that anymore. It is clumsy. It is inefficient.
Was that enough optimism for you from Mr. Chadha?
You know, it's interesting. It's actually not that optimistic compared to other people now.
On, he's going up to 4,500.
But that's only for the first, it's the same as the year end. It's going to be all in the first quarter, then it's going to be chopped.
Oh, come on. David Foulkes-Landau called up Chadha and said, my deepest sympathies. We'll leave it there. At Deutsche Bank. Pinky Chadha, thank you. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and Germany will provide Ukraine with a significant upgrade in firepower to use against Russia. Berlin has confirmed that it will initially supply the Ukrainians with 14 of its Leopard main battle tanks. The first German tanks will deploy to Ukraine in 3 months. The Biden administration is expected to announce as soon as today that it will offer Ukraine the M1 Abrams tank. In the UK, the government spending watchdog reportedly will cut forecasts for growth. According to The Times, the Office for Budget Responsibility told Chancellor Jeremy Hunt that it overestimated the prospects for medium-term growth. That will leave the government with a multi-billion-pound hole in its spending plan. Senate Majority Leader Chuck Schumer is telling Republicans, show us your plan. Schumer and other Democrats want the GOP to offer a proposal for raising the debt ceiling and avoiding a default. House Speaker Kevin McCarthy and other Republicans are demanding spending cuts in exchange for increasing the borrowing limit. AT&T forecasts profit and free cash flow for this year that missed estimates. It's another signal that high costs are hurting prospects for the wireless industry. Mobile growth was better than expected, with AT&T adding 650,000 new subscribers. A downbeat forecast from Microsoft. The software giant says revenue growth in its Azure cloud computing business will decelerate in the current period, and it warned of a further slowdown in corporate software sales. Meanwhile, Microsoft has resolved widespread problems with its online services, including Outlook and Teams. The company said the problems were due to a recent alteration to its network configuration. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Either. I'm prepared for either.
Earnings season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
Does this quickly become just a really crappy business model?
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
For 15 years, Google has pursued a course of anti-competitive conduct that has allowed it to halt the rise of rival technologies, manipulate auction mechanics to insulate itself from competition, and force advertisers and publishers to use its tools. In so doing, Google has engaged in exclusionary conduct to severely weaken, if not destroy, competition in the ad tech industry.
Good morning, everyone. The Attorney General of the United States, Merrick Garland there. Thank you to Mandeep Singh for giving us perspective there on this lawsuit. Lisa, final word there on the lawsuit. What do you think?
If this is actually a harder line from the Department of Justice, does that indicate that you're going to see some spending from big tech go elsewhere? And what does that mean in terms of other tech giants?
And this is your academic, so I mean, I don't think I'm going to catch you unawares. If we get a Republican president or a Republican this or a Republican that, does the suit change? I don't know.
The Department of Justice usually is somewhat insulated from the politics, but the follow-on suits probably will be, the expectation of them will be less, right? I mean, that's typically the Republicans would come out with less of an antitrust kind of thrust than the Democrats, and that's what a lot of people would be expecting.
One of the charms of Anne-Marie Horton, our chief Washington correspondent, is real-world experience, particularly in Europe, and over to Moscow over the recent years, and we're thrilled that she could join us right now. Anne-Marie, on the tanks, have you ever been in one of these tanks? I can just see you out in some junket with a helmet on.
No.
Have you ever been in one of these tanks?
No, I have not.
I am dazzled.
Send me.
I'm dazzled by the technology lead, clearly superior to what the Russians have as well. General Ben Hodges, has been out briefing with his expertise in the Army with actual knowledge. What can they do? Like, if they get them on the ground and they have a range of a diesel engine of 200 miles every fill-up, I mean, do they just move forward? Is that the belief?
Well, that's definitely why Ukraine wants them, right? They want to be able to not just hold the line in eastern Ukraine and be able to get ahead of what they think is going to be a spring offensive by Russia, but they want to make those inroads into eastern Ukraine and get back that land that Russia has occupied and has been holding. I mean, I think the main point you made, Tom, was that these tanks are far more superior than the Russian tanks. I don't know the ins and outs. I'm not a tank expert and haven't been in one, but they have thermal imaging. I mean, they're incredibly high tech, and they have been used all over the world. These are the tanks that have shown up in Kosovo. These are the tanks that have showed up in Afghanistan. I think the main point is that these are the tanks that Ukraine believes they need to continue fighting this offensive and to make inroads really in this offensive. And the fact of the matter is once again, you have seen the West unite. Germany was pretty direct. We will not send Leopards if there's no Abrams. And now you're getting both.
We're getting both in the British tanks, I believe. As well, let me ask you, Maria, a question today. Why doesn't this just expand down to an advance of the superior hardware on Crimea? To me, the Crimea is the unspoken story here that we can get out front on. Is that part of the story?
Well, there was reporting recently from the New York Times about U.S. officials are maybe warming up to Ukraine looking at potentially having an offensive in Crimea or using weaponry to make inroads in Crimea. Crimea obviously is a little bit different when you're looking at the fighting that's going on, because Russia has held Crimea since 2014. Really, the new fighting has been more in eastern Ukraine and mainland Ukraine. Towards Kiev.
But Anne-Marie, why has this been such a controversial push? These tanks, in particular from Germany, have been incredibly contested within the nation. What's behind that?
Well, Robert Habeck, the vice chancellor, also the economy minister, told us on Bloomberg that they do not want to act alone. And then he made a reference to, obviously, we have lessened our defense because of our historical past. This is a huge reversal for Germany. This is literally like moving a tank for them. It is a U-turn in terms of their energy policy, in terms of their defense policy, and Germany does not want to be the ones that provoke Russia alone. So for them to make this move, they wanted to make sure the United States was on board. The U.S. argument is that the Abrams are much more sophisticated, much more difficult to operate. They do consume a ton of fuel. They have a jet engine in them, and they are just not as logistically feasible as moving them to Ukraine as it would be the Leopards. But Germany was very clear. In order for us to do this, we need the U.S. to act alongside with us. But the whole theme is that they are concerned about provoking Russia. They want this conflict to maintain, this war, to be within Ukraine. They do not want this spreading to NATO nations.
So where has the psychology shifted in terms of what an escalation is?
It's a great question. What the Kremlin has said in return to this announcement of the more tanks, the NATO weaponry going to Ukraine, is that they will just be destroyed as all other military hardware has been in Ukraine. That's what Dmitry Peskov has said. But when you hear from Medvedev, who recently was talking on Telegram about all of this, he is talking about the fact that he is prepared, or Russia is preparing for a prolonged war because of the weaponry that the U.S. is going to send to Ukraine. So it does seem that Russia potentially is going to view this as the West is not backing down. Even if critics say they drag their feet, and I spoke to Ukrainians, I recently spoke to Yuri Sak, who's an advisor to the defense minister. He was here in the United States about these exact conversations. When are you going to send the tanks?
Right.
Russia is getting the signal that they also need to prepare for a longer, protracted war.
Emery, thank you so much. Greatly appreciated. Emery Horton with a brief there on tanks. Learned a lot there here on what we're doing with the Abrams, the Leopard of Germany, and of course the British tanks as well. There are a set of headlines here which have something to do with Bramo's kids trading at the opening yesterday. They swamped the exchange. I get one report, it was 80 stocks. I get another report, it was 200-some stocks. Yeah. And the key thing is they have algorithms that come up with a first price at 9:30, and that didn't happen.
Well, and what happened yesterday at the opening bell of the New York Stock Exchange was bread and butter stocks, McDonald's, Wells Fargo plunged by billions of dollars in market value, and then were halted, and the volatility
Morgan Stanley
was
went down
tremendous.
13%.
Exactly,
yeah.
And it raised a question, okay, what's going on here? Is it somebody jamming the system? Is this just a complete glitch in the system? Right now, New York Stock Exchange is saying that there's a short sale restriction that's going to be lifted in a subset of symbols, and that some short selling restrictions were wrongly triggered yesterday. There are a lot of issues here, Tom, but to me, how vulnerable is a system that has more volume getting pumped through it, and what's the potential liability? Is this just a glitch? They didn't necessarily honor some of the trades, so it wasn't necessarily that money was completely lost, but there's some real questions stemming from this.
It'll be interesting to see how they mop up people that took advantage of this in a constructive way versus people that, you know, is an amateur sense, I would say, were nefarious, because it's not like the crash of '87 where we didn't know for 3 or 5 days what we owned and what we didn't own. This is the micro speed that we're all going at today with no spreads.
Is it enough for the New York Stock Exchange to come out and say, our bad, sorry, we'll fix it? Or is there something greater that's going to be required in order to create some sort of credibility and make sure that this doesn't happen again? Because this has been a big concern, the vulnerability of split-second trading and huge volumes that are trading on that. What happens if there's a glitch? What happens if there's a hacking? What happens with cybersecurity? I mean, all of these issues that people have been raising, does this sort of raise the ante a little bit?
Can I ask simply why this doesn't happen more often? Are we just, almost like the FAA and the plane computers of a week ago where the nation was shut down with flying? I mean, we're all slaves to these computers. That's all there is to it.
Well, that's a great question, right?
Did I do okay there?
That was good. No, it's true. That's the glass half full side of things that perhaps,
Well,
we should be impressed that it doesn't happen more often.
ICE called me last night. They own the New York Stock Exchange. And I said, well, look, if you're in the triple leveraged all cash fund, this wouldn't happen. I mean, that's all there.
How's that working out?
You wake up, you look at LIBOR, and you go back to sleep. Stay with us. -32 on futures.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
Bloomberg surveillance from London, from New York this morning. In Washington are Jennifer Jacobs and Amory Horton confirming frontrunner status and top contender status of the Vice Chairman of the Federal Reserve, Lyle Brainerd, to be considered to advise the President in the position now held by Brian Deese. This will be most political, leaving a senior and, Lisa, I would just say different Vice Chairman post at the Fed. Lyle Brainerd is Vice Chairman, is different than Richard Clarida is vice chairman.
Leah Brainerd was number 2 at the Federal Reserve. She is number 2, and she's been pushing back on the margins against this feeling that the Fed has to go much further, and is talking about the balance of risks to the downside in terms of economic pain. So what does that do if she leaves, and who replaces her? And then there's also the questions of some of the political interference that some people are going to raise.
It becomes a new debate, but she's going, if she was to go back, and the Washington Post was suggesting that the Secretary of Commerce, Gina Raimondo, maybe has said she doesn't want to do that. That's speculation at this time. But Jacobs and Horton are reporting here on someone who is comfortable with policy, working with Bill Clinton on the same council as a very young academic out of Wesleyan. I believe she was teaching at MIT at the time. I don't recall that. But I would really suggest that policy is where she's more comfortable than worrying about dynamic stochastic general equilibrium theory.
Whatever you want to say about her, she is a very respected academic mind and policy mind. So people might get a lot of support behind her, even though, perhaps there are going to be questions around the Fed leadership and who replaces her and what that means for the Federal Reserve.
Brainerd is front runner to run the Biden Economic Council. On the data front, a deterioration through the morning. Microsoft leading that deterioration after up nicely. Negative 33 on SPX, with Microsoft visiting 236, even 235. Yields come in. John Farrow making note of that from London. There's just simply no question about that. It is earnings season. Quickly, Lisa, on individual names.
Yeah, well, I just want to tell you this, that Boeing just crossed, and their fourth quarter adjusted free cash flow is $3.13 billion versus an estimate of $2.89 billion. So just to give you a sense, we are getting a motley picture. I keep going back to this with a lot of companies talking about pretty good earnings, at least so far, although with a bit of a softer picture ahead. Microsoft, key among those yesterday, saying that they are expecting a bit of a deceleration in the growth in the Azure platform. Those shares lower by 2.4%, gaining back from some of the lows earlier this morning. Tesla shares down 1.1% ahead of earnings later today. A lot of people looking not only about Tesla's sales, why they've been discounting their vehicles, but also will Elon Musk talk about the next phase in the Twitter saga? When he steps down, who's going to replace him? And AT&T came out. This, to me, is oddly interesting because AT&T actually gave a disappointing forecast going forward. And this follows on what we heard from Verizon yesterday. And yet the shares are up 2.3%, which raises this question of how much bad news has already been baked in. How much pessimism has already been established in the levels of certain names?
Well, we'll have to see on that. I would say the shock to me, as the shock is to anybody worldwide who follows aviation, like John Farrow, is to see that the headline from the Boeing company is out of Arlington, Virginia. That will be a shock across all of my youth into middle age, from Seattle to Chicago to outside Washington. That describes the travel experience of John Farrow over the last number of weeks. He joins us now with a really important interview conversation with Jane Foley.
Thank you, TK. I have to say the travel's been pretty smooth over the last week or so. Maybe I've been lucky. Let's frame the last 12 months. This is important. We've been wrestling worldwide with inflation, and central banks have made a move. The ECB's gone to 250. The Bank of England's gone to 350. The Federal Reserve has gone to 450. The Bank of Japan, the BOJ, has done absolutely nothing. Is that going to change this year? Jane Foley of Rabobank, alongside us in the beating heart of foreign exchange. Jane, fantastic to catch up with you. Let's start there. Sub-zero at the BOJ. Is that going to change this year?
You know, it might, but it might not. And I think that's the really crucial point here, because if we saw, the meeting in January, we saw speculators all egging on for a change in yield curve control, and what do they get? Nothing. And I think this is the risk. The market's now assuming that we're going to get a replacement for Kuroda in April, of course, as he steps back. And they're assuming that we're going to get maybe a significant change in policy. We might get a change in policy, but it may not be significant. And that's the point. We might get another tweak to yield curve control. We may get an interest rate hike. We may not, because if you look at the time frame for the Bank of Japan, they're probably not going to be hiking interest rates next year when, for instance, the Fed could be easing and other central banks. So you've got a limited time frame. But then you look at the fundamentals. At the fundamentals, yes, inflation is above its target, but only because import prices are are not because it's domestically generated, which is the golden goose for the Bank of Japan. And if Kuroda gets replaced, there's a very good chance that he gets replaced maybe by one of his deputies, maybe by somebody else from the Bank of Japan, all of which have been supportive of the very accommodative policies for a long time. So disappointment could be coming.
Well, let's pick up on what you just said as the replacement. I think that's what gave everyone's attention, the fact that we have this final meeting with Kuroda in March and then the handoff in April. Which chalice carries the most poison? Does Governor Kuroda hand over a policy already set on a path to move away from yield curve control and towards higher interest rates, or does he hand over what there is right now? Which chalice carries the most poison?
I think it depends on the outcome of the spring wage rounds, really. And you know, the indicators are that, yes, the spring wage rounds are going to bring some moderate increase in domestically generated inflation, wage inflation, which is what they wanted to see. And, you know, that could lay the framework for a change in yield curve control and another tweak. Will it lay the framework for a change in interest rate policy? Well, you know, that's a little bit further down the line. I don't think we can make that decision yet. But, you know, the Kuroda might be leading the Bank of Japan, but he leads it with a whole board. And that board won't necessarily be changed that much. So I think there is not going to be this massive change towards a very hawkish central bank. You may get a slightly less dovish central bank.
The perspective within the BOJ was that this was perhaps a once-in-a-generation opportunity to reset inflation expectations higher. He's been doing this now for 10 years. I think we all remember when he took this on back in 2013. Does he leave, walk away, with any success whatsoever?
I think there is some success. I mean, again, that harps back to the whole Peter Pan issue, the whole psychological issue that he thought that if you bring in an inflation target, people would assume that inflation might be higher and they would alter their spending behavior accordingly. But as we know, that really has taken a very long time. But, you know, with inflation around the globe, this perhaps has given a little bit of an impetus into inflation. So there is a little bit here. You've got the government of the Bank of Japan behind Kuroda. You've got the Prime Minister saying to firms, yeah, you know, guys, you need to raise wages. And therefore you get what they're looking for, which is this virtuous circle behind higher wages, higher domestic demand, higher profitability, etc. And there are some glimmers of optimism that this might be coming, but I don't think there's a huge amount of confidence that they're there yet, hence the cautious tone.
You've implied there could be some disappointment. Dollar yen's come back from 150, sub 130, about 129 right now. Push that through the FX market for me. Where does that leave dollar yen?
I think we could still see 128 in 3 months. Of course, we are assuming, of course, the dollar is weak, and that's perhaps a large part of that movement back from 150. So, you know, 128 is possible. Like I say, you know, there is the possibility of another movement, another tweak in yield curve control, maybe some indication that they could move away from that in the months ahead. But the problem is, again, is that the window of opportunity is quite short. So 128 is possible, you know, maybe even 126 in the middle of the year. But I don't think we're going to be, you know, falling hugely in dollar yen beyond
You mentioned the US dollar. I remember Tom, Lisa, and I sitting here with you, maybe in September. I think it was back end of September, we were looking at cable at 103.50, strong dollar, euro dollar, 95 something, strong dollar. It's all backed away since then. I think it's been a 11% move on DXY. I'm sitting here this week trying to work out what's durable about all of this, particularly for euro dollar. I know there is a positive surprise. I know that we've got that adjustment as we move away from the risk of recession. What's durable about these tailwinds that we're seeing start to build?
Well, you know, I think this is really particularly interesting when you come to the euro part of euro dollar, because, you know, the market has now priced in a much better situation than it was supposed to be. We were supposed to be in recession for Germany, and now we've got the Scholz, the Chancellor last week, saying no recession for Germany. We've got the governors of the Bank of France, the governors of the Bank of Italy saying, yeah, you know, our outlooks are improving. You look at the performance of European stocks this year relative to US, so that the market has been buying into this far better than expected story for Europe. And we've got euro dollar, you know, touching this week at 109. I think the big question is how much of that is priced in and how much further can the euro sort of dine out on that story? Because, you know, it looked this week at the PMIs. The PMIs were like, oh, you know, they're not really that good. There are still headwinds coming. And as we move into certainly into the summer and the autumn, we could have another phase of the energy crisis. We don't know how cold next winter is going to be. So there are still headwinds facing the euro, and the market now is quite long of the euro. So don't think it's going to be that easy to push up to another leg. But of course, a crucial element of this is the dollar, and will the market continue to disbelieve the Fed guidance about the interest rate outlook for this year?
So I've asked this question 3 times this week. Maybe you've heard me ask it. Let's make it 4. Who hikes more this year, the Fed or the ECB?
I have heard you ask that, and I have heard the answers, and I think you know what I'm going to say too, because it's the same as everybody else. You know, the ECB is likely to hike more, but the question really is that in the price now or not?
It's 4 for 4, but that's an important question, that's for sure. Jane Foley of Rabobank, fantastic to catch up with you here in London. TK, these are really, really important questions for this continent, for Europe, and for that single market, for the euro-dollar.
Well, it singles, John, the year-ahead uncertainty. I like your idea. We ought to do our year-ahead outlook on March 31. I know you're beginning to dive into yours right now. We'll have to see.
I'll share my outlook a little bit later this week, Tom, but I agree with you. It always resets a few weeks into the year. Why don't they just wait? Why don't they just wait to launch their annual?
Because
I don't know.
We're members of the media. John Farrow, thank you so much.
They got us out. I get it.
On a great day there with St. Paul's. For those of you on radio, St. Paul's mired and missed. As his opinion of the theoretical physics PhD from New York University, Marko Kolanovic speaks, Lisa. We're channeling John Farrow right now, and we could speak about Marko Kolanovic trying to extricate himself as an Uber bull of last year.
Well, the fascinating thing, he's gone a complete 180, right? He went Uber bull and now he's Uber bear. He's basically saying that people are ignoring the fact that fundamentals are deteriorating even as people are rallying behind stocks. And so, at what point is he a contrarian indicator? And at what point is he really onto something? Because that fundamental data is sending a message that's different to some of the enthusiasm that we're seeing in other instruments.
Huge lesson for all of you watching and listening here, the distinction of how Marko Kolanovic approaches this versus Binky Chadha is starkly different in the level of certitude. And when Binky finesses it out, it's going to happen. We're going to get optimism out there, where Marco's trying to be more abrupt, more stochastic about his call.
Facts have changed on the ground, and so he has changed, but he's changed in the opposite direction of everybody else, and this is fascinating to me.
Futures -32. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and Germany have overcome a disagreement that threatened to fracture Allied unity. They've agreed to give their main battle tanks to Ukraine. Germany confirmed today that it will send 14 of its Leopard tanks to Ukraine, and eventually there will be more. Meanwhile, the Biden administration is expected to announce as soon as today that it will offer Ukraine the M1 Abrams tank. In China, Lunar New Year travel and movie box offices are showing signs of recovery. In the first 4 days of the holiday, the number of trips was over last year. Meanwhile, the number of movie tickets sold was higher in 2019 before the pandemic. Google says the U.S. Justice Department is doubling down on a flawed argument by suing the company on antitrust grounds. 8 states joined the federal government in calling for the breakup of the search giant's ad technology business. The suit claims Google has illegally monopolized the digital ad market. Rupert Murdoch is dropping plans to recombine Fox and News Corp. In a letter to both companies, he said that combining the 2 media giants that he controls isn't optimal for investors. The controversial deal aimed to reunite the parents of Fox News and the Fox broadcast business with the print operation that includes the Wall Street Journal, the New York Post, and HarperCollins. And the UK's antitrust agency has kicked off the first stage of an inquiry into chipmaker Broadcom's proposed $61 billion takeover of cloud computing company VMware. The transaction marked the biggest ever takeover for a semiconductor maker. The European Union is also looking into the deal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnsons, more Michael Jordans, more Magic Johnsons, and Oprah Winfrey's and the like.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Cutbacks have actually rewarded stocks over these last several months, but there's a finite aspect to that. Because, you know, when you look at the way reports are coming in, there's only so much you can do to massage your bottom line if your top line's decelerating.
That's an interesting conversation. Julian Emanuel working with Edward Hyman there on the equity markets. I can't say enough about his day-to-day report of earnings season. We protect the copyright of our guests. You can get that from Evercore ISI. But Julian Emanuel making real clear corporations will adapt. And wrapped around that is Ed Hyman's call of significant disinflation to move under 3%. Futures negative 33, Dow futures negative 225. VIX nudges up above 20. Lisa and I are noticing here in the fixed income space some real idea of a slowing economy, as witnessed by a 2-year yield now to 4 digits, 4.1353. We're not yet on the 3.99 watch on the 2-year yield, but that's come in with an 8 basis point vengeance, to say the least. William McDonough is founder. He's chief executive officer. They've got a bunch of other titles for him at Element Funds. What he is one of the wisest people across a span of this thing called wealth management, is managing money and really, really trying hard to do the hardest thing, which is not lose money. We are thrilled that William McDonough can join us today. It's wrapped around Tesla. It's wrapped around what Mr. Musk is doing in these historic Muskian times, but there's about 8 other things to talk about as well. Will, thank you for joining us. You really center in your research note that the Tesla cars are a Trojan horse. Many people agree with you on that. What is Mr. Musk really up to?
Well, you know, let's look back to 2006 when Musk really kicked this thing off, and his kind of opening mandate for the company was build a sports car, use the money to build an affordable car, use the money to build a more affordable car, and provide zero emissions power generations options to the world. He's following that. We need to listen to what he said. And I think what we're going to see from Tesla when they report today, we might not see Musk. I think they're starting to realize that maybe he isn't the optimal person to do the SEC communications, much like Apple did with Steve Jobs back in the day. Let's throw a black turtleneck on this guy. Let's put him on stage. Let's talk about the Cybertruck. Let's stop all these communications with regulators. That ain't his highest and best use.
I love that view of Tim Cook. Basically, how much can you put him into the background?
That's not a grab down a coddle. Continue.
Will, when you say a Trojan horse for the EV, for the battery, is this a positive for the stock or a negative when you look at its longer term market share and potential?
Well, you know, I was interested in what Julian just said, and I think there's a broader war on Wall Street right now and a juxtaposition between the top line and the bottom line. Like, what are we being judged by these days? We just came out of an environment where it was growth at all costs. I don't care what it costs to acquire a user, get the user. And then the tide went out and we saw that that probably wasn't the right way to approach it. And now people are repositioning their thoughts around, well, what's the bottom line? What's the revenue? What's the EBITDA? And when you look at a company like Tesla, you know, there's no justification for it being a $1.2 trillion company. We have our perspectives on why that happened, which I'll share. But when you really look at their numbers, you know, they have less revenue than GM, than Ford, than Volkswagen, than BMW, but they have 8 times the market cap of Ford and GM. So what are we really doing here? What are we really looking at? We think investors play Tesla as a vehicle to get exposure to EV adoption. But what our business Charge, our ticker on the New York Stock Exchange, allows people to do is just buy the base metals that are required for all EV, all solar, and all wind.
Well, but Will, then what are you looking for in today's Tesla earnings? Because it sounds like you've got a very strong belief. There are a lot of questions people are going to be asking about the discounts that recently Elon Musk and Tesla instated in some of the vehicles. What are you looking for to inform how much you amp up your view?
Yeah, I think that they're going to put their toe in the water a bit today. I don't believe that they're going to come heavy. You know, they have announced that in March they're going to do their first investor day, and they're going to brand that. There has been talks that they're going to launch their own investor platform that's going to allow for them to engage directly with their investors, much like you've seen Musk do with Twitter, polling, do you think I should be CEO or not? I think you're going to see more engagement directly with the investors. The investors feel like they're doing what they want to do. But if I'm Tesla and I'm on the board of Tesla, as I alluded to, I'm putting him back in his corner and saying, go stand next to the semi-truck and let us report the numbers, and then let's do the fancy stuff and the exciting stuff in March.
Well, I got 8 ways to go here. And to get you on here on Tesla and Musk is interesting. I want to go to your experience, not only with Bob Diamond, and we thank Bob Diamond so much for coming on recently on the death of Scott Minerd, but I want to talk to you, Will, about your stance in Florida and your management of people's money, celebrity management, and that, in this thing called crypto. The Bitcoin losses have been taken, but far more the upset of crypto right now, which is tarred and feathered, I believe, one of your clients over the years, Mr. Brady, who throws footballs in Tampa. Tell me about the McDonough view on crypto.
Well, I think what happened in crypto in the last kind of 100 days is net positive for the industry. Because it flushed out a lot of the centralized players. It flushed out a lot of the unregulated players, which crypto needs to have a barbell approach to success. It needs to have pure decentralization that allows people globally to interact with it in a fair way. And then it also needs to have a heavily regulated on-ramp that allows investors and allows scale to come into the space and trust who their counterparties are. And I think if both of those things are accomplished, blockchain has no end.
How does the United States use a regulatory reach internationally given the criminal allegations within crypto?
The U.S. is the on-ramp for all global financial systems, right? I mean, let's just admit it. The volumes that come in through the U.S. markets, the volumes that trade on the U.S. exchanges, this is where the money comes from. Even if it isn't sourced here, it's managed here. And so this is the on-ramp to crypto. That's how they can control it, is by saying, we control how you get money into the system and out of the system. And then the good thing about these blockchains is that they're very easily auditable. And so once you're on that system and we know who you were coming in, I can track what you do while you're in there.
Right.
And then I can see you come back out.
But do you have any, with your immense, international perspective here, your work at Goldman Sachs over the years, et cetera, William, I'm absolutely fascinated how a guy like you feels Department of Justice or SEC can fix the international regulation conundrum of crypto. How do you envision them moving forward?
I think they need to do it just like they've done any other industry over the last 100 years. You got to punch it right in the face, and you got to address it and embrace it and really get to know it and understand it. Some of the times they've come out with statements have just shown that they actually truly don't understand the underlying.
Right.
When I believe that the majority of the real players in crypto embrace that regulation because they know that that will open up those floodgates for that institutional capital. And so they just need to really get people around the table that know what they're talking about and put some regulation in place that brings comfort.
To be clear here, Will, Bitcoin 15 to 23,000, are you considering it's appropriate in a portfolio today?
I always do. You know, I think Bitcoin's trading at year end was somewhat driven around the fact that people tax loss harvest into the new year and they realize that they can put a little bit away. People don't realize that Bitcoin isn't subject to wash rules. So there's a lot of trading like that occurs. And then you've seen a lot of people leaning in here in Q1 because the FTX stuff and a lot of bad stuff flushed out in Q4. I'm not sure how much bad news can continue to come.
Well, thank you so much. Very candid there. William McDonough with us from Element Funds today. Lisa, I think it's just a huge conundrum. I mean, there are optimists on crypto, as Mr. McDonough, and that's his track record, is he's been a real optimist on Bitcoin, which is great. But what do our government regulators do about, and I'm just picking these countries out of a hat, folks. I did this. I used to play, did you play Risk as a kid? 3 on 2.
My kids play that.
4 on 5, whatever.
They used to.
Kazakhstan, Turkey, all of Eastern Europe, on and on, China, and the rest of it. Well, how do they reach out to that? I haven't figured that out yet.
Well, and how much do you get some sort of unified system in these different nations that can't agree on anything in order to come up with some consistency and inter-border kind of payments, which is one of the main targets for a lot of the crypto world?
What do we see on earnings right now? I mean, I know we got 25 companies, I believe, reporting.
There are a lot of interesting, interesting
Boeing
stories.
is always interesting.
Boeing is interesting, and the shares, I believe, are lower after they had a couple of disappointments. They're down about 1.7%. Kimberly-Clark, I find this really interesting. They actually were fine when it comes to profit, but sales came up shy, which is perhaps part of the reason why they're declining. But Forex, cutting operating profit this year by $300 to $400 million.
Thank you so much for bringing it up. The breakout I'm seeing is 4% is the new 2%. It's a hit. I mean, it was a strong dollar hit, and we'll see which way that cuts with a weaker dollar. DXY 102 right now. Please stay with us. Lisa Bramwitz in New York. John Farrow in London. He has an important investment conversation coming up. Stay with us.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities,
breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
This feared recession, the food and energy crisis, which was so talked about last year, is just turning out to be less threatening than expected.
I think, yes, there's a potential that we see a little bit of an uptick in commodity prices.
Maybe the debate shouldn't be, are we going to have a recession? Maybe we actually should be having a debate, are we in a recession?
What will matter is that we don't think the Fed's going to be cutting this year.
Right.
We also think inflation is going to be sticky.
I think we end the year lower, but not a lot lower, because we don't see that economic collapse recession scenario.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Welcome back. Good morning. This is Bloomberg Surveillance on Bloomberg Radio, on Bloomberg Television. Tom Keene in New York, John Farrow in London, Lisa Abramowitz here in New York as well. The earnings parade grinding on ahead of the storm, which is next week's Fed meeting.
It's the next week's Fed meeting, but I hope the Vice Chairman Brainerd will show up. Anne-Marie Horton and Jennifer Jacobs reporting she's considered for a White House position. But what's important to me is a real whiff this morning of true economic contraction. I don't want to say recession, contraction, slowdown. I'm looking at the fixed income market, and it's saying the 4 digits 2-year yield sluggish, 4.1373%.
7 consecutive composite PMI reads in the U.S. below 50, basically in contraction period. You do see these earnings coming in with softness in the expectation going forward. You do see a lot of signs of this deceleration, but is it enough at a time when you still do have that persistence, particularly when it comes to wages?
In this hour, we get the first look, fourth quarter GDP.
I believe that's tomorrow.
Tomorrow, my fault. We get mortgage applications coming up here and saw them, and they were pretty tepid here off of what we saw in the previous month. And then tomorrow, we get the enthusiasm of 2.6% Q4 GDP. That seems like long ago and far away.
Exactly, which is why a lot of people are looking to some of this anecdotal data. The leading economic indicators, a huge raging debate on Twitter about whether we're already back to 2% inflation based on the ongoing data, and that perhaps is what's feeding into what you're seeing in the bond market.
Oil finally pulls back. A dash to 90 didn't happen. We're taking a pause. Maybe it's an economic contraction pause. We'll have to see from there. Why don't you do a data check here to keep it going with Bitcoin 23,000? I thought Will McDonough was really interesting there.
A lot of people have
enthusiasm
optimism
on Bitcoin,
on the idea that you haven't necessarily seen the incredible implosion that you might have seen if you really did believe that it was going to get deflated by regulation. We're seeing softness after a bit of gains to start the year. S&P lower by 0.8%, 39.98. You have a euro a little bit softer than the dollar. Again, though, a lot of people optimistic on the euro region, 108.78. The 10-year yield and the 2-year yield is where you're focused, Tom.
Right,
and you're right to do
right.
so, with yields coming in 34.21 for that 10-year.
And the breakfast you and I had, I mean, you had the avocado toast to go with the egg over easy, and I had, I'm trying to be healthy, folks. It was a bowl of oatmeal, and, we moved on. I had a berry. I didn't have berries.
No, just one berry? Is that your diet?
Just one berry. Others are not having a bowl of oatmeal and berries. They're having fagotini au champagne, trésor de bois, pulp marron et madere. Oh, that must mean John Farrow is in London restauranting as he goes, and he joins us now after the souffle Suesses.
You're killing me. This morning, for what it's worth, porridge with milk, Tom, some berries on the side. I shared that with you. Bit of scrambled egg. Just getting the diet. Gearing up for the summer a little bit later.
Oh, it's a restaurant on the way back from Fulham. I get it.
I'm not going to touch that story. Here's a story for you. I've got a gentleman next to me who is short Amazon and long Apple. That's the lead. Let's pick it up with Patrick Armstrong, the Chief Investment Officer at Plurimi Wealth. Patrick, let's start there. Sure. You are short Amazon. I'm looking at Microsoft down this morning by 2.8%. What do you take away from that? that feeds this short of yours?
Yeah, I think over the last 9 months, the cloud business of all the big cap tech companies have been incredible, going at 50%, falling to 40%, and then Microsoft's actually lowered guidance a little bit, maybe expecting great growth, but not crazy growth. And I think that's where cloud is going to. It's definitely a growth industry. I still think there's a bit of pricing in that you are going to have 40% compounding growth for a few years, and it's not going to happen. So the cloud business is where Amazon gets all its earnings. Its retail business is what everyone thinks about it. It's not even generating any meaningful earnings there. So it's a company that's expensive. Apple's a company that's mildly expensive, but I still think there might be a bit of multiple compression as more reality gets priced into the cloud out of Amazon.
Is there a decision that could be made in the C-suite that would make that short painful for you? What could that decision look like?
I don't think they can really do it. I think if you really change the pricing structure in Amazon where they price their retail goods to get a realistic and profit margin that can be sustainable in the future and generate outsized returns on equities, we're not in the pricing environment to do that. We're not in a period where companies are going to be getting expanding margins. So I think Amazon's going to do that. They've disrupted retail, but they've really not profited from it yet. I think at a time when we go into an economic upswing is the time they'll do that. And I wouldn't want to be short Amazon forever, but for the current market environment, the multiple it trades at, and we've still got quantitative tightening, we've still got a hiking Fed, expensive companies are going to remain under pressure.
They doubled their workforce from 2019 through the pandemic. Meta did the same thing. Meta cut its workforce by 13%. Are we not going to see the same thing at Amazon? Is it just a different kind of business that doesn't have that option?
Well, they're going to be cutting. They've even admitted it. They've overbuilt their distribution. They've overhired. So they've started to make not meaningful redundancies, but they've indicated there's going to be some. So there's going to be more of that, almost certainly. They're overstaffed. Technology is overstaffed. Amazon's got a more real-world component to it than most tech companies. So I don't think it'll be the same magnitude as cuts elsewhere, but it is something that they probably are overstaffed.
Every tech firm you look at right now is making those cuts.
Yeah.
Amazon, Microsoft, Alphabet, take your pick. Apart from Apple, we're not seeing that take place at Apple. You are long that name. That name has suffered a little bit towards the end of the year. Walk me through why you're still long that name.
So when you look at the multiple, look at the defendable profit margins and China reopening, China was a big risk for Apple, and I think we're not past that, but having China zero COVID was a big risk to the manufacturing, big risk to the consumption out of Apple products in China, and I think we are moving past that. And it's trading at a multiple that's not cheap versus the MSCI World, but it's a dominant company with really sustainable profitability. It's got ongoing revenues now from not just selling merchandise, but subscriber fees, those kind of things. I think it's an attractive multiple for a dominant market position.
It's got the recurring revenue stream. I just wondered to what extent some of this revenue story is challenged by the economic conditions of the moment. How challenged is it? And are we going to start to see maybe that upgrade cycle just face some headwinds through the next several quarters?
I think it will be facing headwinds. The consumer environment's not strong. We've not seen any meaningful change in the employment situation. You're still seeing wages rising, still seeing companies basically trying to fill job openings. But the hikes we're getting from all central banks, they have a lagged impact, and they're designed to create unemployment, designed to reduce demand. So the consumer is going to not be a tailwind, but the companies that do have dominant market positions have a product that's not a commodity, I think can defend those margins. And I think Apple fits into that along with luxury companies. The high-end consumer is well-placed. Low-end mass market consumer, I think, is going to face some difficulty.
Let's talk about the high-end consumer. Bank of America put out a note in the last week or so, and they're discussing the prospect of a white-collar recession, that maybe you won't find the resiliency where you used to find it. What would you say back to that?
I'm not sure where the recession is going to come from. I do think it's going to be a broad-based consumer slowdown driven by a slowing economy. We're not in probably the worst economic outlook that maybe we feared a few months ago, but things aren't good. The U.S. is on the cusp of a recession. A minor recession or a shallow recession is probably where it gets to, but consumer demand will remain relatively robust because people who want to work can find jobs. They are getting pay rises. The amount of debt is high. Where the redundancies come from, I think it is going to be pretty mixed. But the highest end consumer, mortgage costs, food costs, energy costs don't matter to them. So the really luxury consumer, I think, is where you want to be selling to, because all the things that are pulling the purse strings of everyone in the world aren't impacting the or the luxury consumer.
You say things aren't good. In Europe, things aren't good. They're just better than they might have been.
Definitely.
And that's been the story over the last 3 months. In the last few weeks, year to date, Euro Stoxx 50 is absolutely ripped. It's up by 8, 9, 10 percentage points. Do you want to be on board with that story? And the question I've been asking through this morning is how durable the tailwinds are. Is that a story that you think can play out through this year?
I was actually short the DAX in Q4 last year, and I closed the short in the early days of January this year. So I was hurt by that. And it's not a move that I've made to go long, but China reopening and the natural gas situation in Germany, I was worried there were going to be brownouts. I was worried you wouldn't be able to get the electricity you needed to manufacture goods, so a real manufacturing recession. And those have been alleviated, those risks pretty much. So I've not really gone long cyclical Europe yet, but I've closed my short. So I'm part of the reason I think the market's really jumped this year.
And that's what I want to touch on. There is a difference between shorts off and longs on. How much of the last few weeks is just shorts off?
Must be a big part of it. I think a lot of people in November, December talk about what's going to happen in the coming year, and you worry about risks, and there were real risks that have really dissipated. So I think it's not people really clamoring to get in on a structural rebound in Europe, but just closing positions that we're betting against something really severe on the downside that's probably not going to materialize.
It's been a difficult market over the last 12 months, that's for sure. Patrick Armstrong of Plurimi Wealth. Tom, navigating some tricky issues, but I've got to say, let's pick up on that short of Amazon. That one stands out for me.
It really stands out, John. It's going to be fascinating to see after the way that Microsoft is going down this morning. John, it has been a grind. And again, as a ginormous country at 8:10 Wall Street time, let's be clear, folks, Microsoft has not found a bid this morning. There's no other way to put that. And John, I think it's sport to say the least. John Farrow in London there, and of course he's getting ready for more conversation, and importantly his 9 o'clock hour as well. Lisa, I want to drive back to what you earmarked, which is the unusualness of a vice chairman of the Fed, a quote-unquote top contender to take over the desk position at the National Economic Council. This is the position Gene Sperling had through Obama and Osama Clinton, I believe, as well. And someone will go, well, this is a demotion. And maybe in modern Washington, it's not a demotion.
A lot of people would say that this is not a demotion. She's currently number 2 at the Federal Reserve. Lael Brainard, we're talking about, the Fed vice chair, who is number 2 to Fed Chair Jay Powell. And she's being, we're reporting both in Bloomberg as well as the Washington Post and others, that she's a front runner to replace Brian Deese as the head of the Chief Economic Council for President Biden's administration. What this means in terms of who fills her role, huge question.
And also, with eyes to Secretary Yellen, if she steps aside, is this just a stepping stone for anyone, including the vice chairman? The politics, the intrigue of Washington. Stay with us through the week for that. Futures deteriorate -33. This is Bloomberg from London, from New York.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and Germany will provide Ukraine with a significant upgrade to firepower to use against Russia. Berlin has confirmed that it will initially supply the Ukrainians with 14 of its Leopard main battle tanks. The first German tanks will deploy to Ukraine in 3 months. The Biden administration is expected to announce as soon as today that it will offer Ukraine the M1 Abrams tank. And as you've been hearing here on Surveillance, Bloomberg's learned that the vice chair of the Federal Reserve, Lael Brainard, is the top contender to be the next head of the White House's National Economic Council. President Biden has not yet made a final decision. Brian Deese has been in charge of the council for 2 years. He hasn't given a date for his departure. Senate Majority Leader Chuck Schumer is telling Republicans, show us your plan. Schumer and other Democrats want the GOP to offer a proposal for raising the debt ceiling and avoiding a default. House Speaker Kevin McCarthy and other Republicans are demanding spending cuts in exchange for increasing the borrowing limit. Boeing ended the year by posting a quarterly loss. The results underscore the work Boeing still has to do to return its factories to full speed and fully capitalize on soaring demand for air travel. Still, Boeing's cash flow was better than expected, thanks to a flurry of jet deliveries. And AT&T forecast profit and free cash flow for this year that missed estimates. It's another signal that high costs are hurting prospects for the wireless industry. Mobile growth was better than expected, with AT&T adding 650,000 new subscribers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Earnings season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
This has quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We've got to live with the ups and downs of equities markets, and we've had 3 rallies in excess of 10% since the Fed started tightening. The real rally, the turning point for the economy, the beginning of a new recovery is likely to begin this year.
Stephen Whiting of Citigroup. Nobody links profit models into economics like Steve Whiting. Dana Peterson to join us here in a bit. Here we'll look at the American economy, getting ready for that look back. Good GDP report of last quarter. And right now, a little bit rocky. Lisa, I've still got to go back to the 2-year yield. 4.14% speaks volumes. It's not the best chart I've ever seen, but it is a grinding lower 2-year yield chart.
Yeah, I do want to bring you this headline that just came because we've been talking about this all morning, the New York Stock Exchange and what happened yesterday at the open. They're saying now that the root cause of yesterday's open issues were manual error.
So that's basically like the same guy that was at the FAA, went over
right,
and worked
exactly.
at the New York Stock Exchange.
So who gets fired, right? I mean, basically someone pressed the wrong button. They said that it's involving disaster recovery configuration. There were some short selling restrictions that were put into place erroneously. I find this fascinating because it really raises this issue, which you've been talking about for a long time, of the electronification of markets and the vulnerability if there's
the vulnerability of it.
Keystroke.
And, here's the answer. At home, if I'm lost, I dial 1-800-AFTERTHOUGHT, and she comes in and fixes it in a heartbeat. That's the reality. Why is the New York Stock Exchange any different than the Keynote? So if I can't get the printer to work, who do I call?
This is now a public service announcement. If you're a tech professional and you've been laid off, contact 1-800-TOM-KEEN. He will hire you.
I just, there it is. Manual error involving disaster recovery. What was the disaster besides, I believe Morgan Stanley went down, what was it, 13%?
Yeah, and you saw Wells Fargo go down 11%. I mean, you're talking big market caps, big moves, and some real questions that need explaining.
Right now, we're going to have some fun, and it's also serious fun because we're all fixated on Vienna or Riyadh and the rest of commodities. And what we can do is we can go 3, 3-2-1 refiners. Will Kennedy does that, as well as our charmed Javier Blas in his acclaimed book. And Will, I thought Javier wrote one of the most important essays I've seen in ages in hydrocarbon. It was a primal Blas scream, pay attention to refiners. Why should we?
Because the refining margins, the refining market look really tight at the moment. Last year, refining margins really spiked to unheard of proportions. One of the reasons that gasoline and diesel prices went so high in the US, it wasn't all about the price of crude. That fell away in the latter part of last year, but as Javier wrote yesterday, it's starting to come back. The amount of money that refiners will make processing a barrel of oil, and the 3-2-1 you mentioned is you get, for every barrel you get 3 barrels, you get 2 of gasoline and 1 of diesel, and you measure the spread on that. And that's now back at $60, and it's not up to last year's levels, but it's historically very, very high, and it means that if you're looking at crude, you may be looking at the wrong place, and it's a signal that gasoline, jet fuel, diesel, what you pay to move around is going to start rising again.
Will, I've got a gallon of gas in the United States. Of course, the great plunge for us, Will, $5 a gallon down to $3 a gallon. We've come up 12% as well. And I get the refinery tensions that are in America. With the war in Ukraine, has not in my backyard changed for refining in Europe?
This is the other huge story in refining this year. So on February the 5th, we get Europe's sanctions on Russian diesel. Now, obviously, they've already stopped importing Russian crude, but the diesel and other products could be a big deal. Europe has historically relied on Russia's refining capacity. It has far too much refining capacity for its own needs to supply it with diesel, and we use diesel to move our cars in a way that the US doesn't. And stopping that will be a big deal, because whereas Russian crude has found new markets in Asia, it's much harder to see those new markets for Russian products in Asia. Asia already has a big refinery sector. It doesn't import products. So the discounts to attract those barrels into other markets are going to have to be huge. And if it doesn't happen, some of those products will stay at home, and it could really be a problem for Europe. And so that's the other point of tension over the next few weeks, is what happens to diesel prices in Europe after those sanctions come in on Feb 5th.
Well, let's just zoom out for a second, because so far the theme of 2023 has been a new bid into crude with China's reopening, with this belief that perhaps we're going to avoid some sort of significant recession. Have you ever had a time where there's less certainty around the push-pull of both recession and the increase in demand from a China reopening?
I think it's a really good point, Lisa. I do think that people find it hard to gauge which direction things are going to go this year. Obviously, a severe slowdown in the wider world could really be a blow to oil and other commodities. But I think on balance, people put together the China reopening, the continuing issues for refining and sanctions that we've just talked about, the lack of new supply coming up on the world, the fact that the shale boom is really starting to fizzle in the US, lack of investment in the industry, and people put that together and have a fairly bullish outlook. But clearly, if the slowdown is sharper than some people are predicting, then that could upend that opinion.
Are the metals markets sending a different message from the fossil fuel, from the crude markets and the other fossil fuels?
I don't know if it's a different message. They are perhaps the standout performers so far this year. Both copper and aluminium are up more than 10% this year, which is far better than any other of the major commodities. And I think that, again, reflects a play on China reopening. Obviously, China accounts for about half the world's copper demand. A big investment splurge in China would be very, very good for copper. They continue to electrify the economy. And again, you have some of the supply side tensions that we've described in oil. In Latin America in particular, there are problems with output in Peru and Chile. So it's a pretty bullish picture for metals too.
Well, quickly here, what's the view forward on OPEC? When's the next soiree in Vienna or some other geography that I'm jealous that you're going to?
Well, the next sit-down meeting probably won't be till June for OPEC, but they do have an interim meeting next week on to discuss what they should do just to keep an eye on the market, their monitoring committee, as they call it. I think our expectation is that they don't see any need to do anything new. They probably hold the same view of the market, that things look fairly stable, fairly bullish, and steady as she goes. So I don't think we're going to get, well, I feel silly for saying this, but I don't think we're going to get much volatility from OPEC in the next few weeks.
Will Kennedy, thank you so much. I got the Javier Blas essay out, folks, on Twitter. You can see it there, and of course through all of Bloomberg as well, at Bloomberg Opinion. Will Kennedy driving forward our hydrocarbon coverage. I'm as guilty of this. I've been guilty of this for a zillion years, Lisa. It's just so easy to get hooked on the upstream romance of exploring, and we're going to drill off Siberia and the rest of it. And you want to talk about a refinery in New Jersey? You know, somebody else does it. I don't want to look at that. I'm not going to read that 8-page report on Marathon or whatever.
Well, and honestly, is this going to be something more discussed about as we potentially get the Strategic Petroleum Reserve, and what happens with them purchasing some barrels when it comes to the elasticity, because of exactly what you're talking about, the refining stickiness and the sort of lack of capacity there.
Well, the lack of capacity, and it goes to NIMBY, not in my backyard, and it's in full force in America. And you heard from Will there the nuances of a European NIMBY, which is to export it to Russia. That's done.
What I find interesting is that you end up with a number of analysts who keep saying they're bullish on energy stocks, regardless of what crude does, regardless of what prices do. And that basically they're minting cash, they're throwing it off, they're paying big dividends. And so there's more momentum behind that, regardless of the uncertainties that we heard Will try to make sense of just there.
Well, it'll be interesting to see. What's interesting is futures deteriorate. Negative 33 is now negative 37. Dow, negative 246. Dow, midpoint between 33, 34,000. The VIX, with that interlude at 19, comes to the angst of 20.12 as well. What am I focused on? It's got to be the deterioration in the 10-year real yield, disinflation in order. Stay with us from London, from New York. This is Bloomberg.
Many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from, and where has it gone? Because right now, it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David. But COVID, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off. in the summer of 75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts. And I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance, we say good morning to you here. Economic data at 8:30, there is none, so we'll move forward here today. We're going to talk about Canada here in a moment, but I do want to get out the calendar on earnings, and please stay with Bloomberg this afternoon for a slew of earnings out on radio, on television. Our team will climb on board that and give you the trends. Like Microsoft yesterday having a challenging day with futures negative 35. And then there's Canada. Lisa Bramwitz with me, who's expert here on the collapse of the Montreal Canadiens, and also it's like a big deal what the Bank of Canada is going to do.
Well, only because they were out front last year when they were hiking rates at a faster clip than the Fed or the European Central Bank, and now they're expected to be the front runners, the leaders in shifting down, the step down to 25 basis points. So that comes at 10 a.m. and that's basically where the currency is trading. The Canadian dollar seems to be sort of pricing in that there will be that shift lower and that they probably won't give a more dovish kind of message at the press
Yeah, it's
conference
going
at
to Bill
11 a.m.
Curry writing it up in Ottawa. I can never pronounce it like the Canadians do. Totally different from this. This is the Globe and Mail with one of my favorite people, which is David Dodge of Princeton, who was the giant former Bank of Canada governor. And he just says simply, you're underestimating the risks of a recession. It's the same debate as here, but they seem to be having it quicker, sooner than we are.
And they were last year, too. So how much of a signal versus noise will it be? And a lot of people are watching the Bank of Canada, and you can sing Blame Canada or whatever you want to do, but they are out front in really creating this debate.
That sounds like a great screenplay you could write.
Thank you.
Blame Canada.
Well, have you ever heard the song?
No.
I'll send it to you.
It was #1 in Fargo. We'll move forward. The future's negative 36 to my most anticipated conversation of the day. No, not John Farrow on dining in Mayfair, but with Dana Peterson. She's chief economist at the Conference Board. And this is a conversation, Dana, I haven't done this in ages, about the economy right now. What tea leaves do you look at to know where we are the third, fourth week of January?
Sure. Well, we look at leading indicators, our own measure, which continues to signal that the U.S. is probably entering into a recession right about now. I know some people have doubts about the measure, but it's done a remarkable job in signaling recession before you have GDP, before the NBER even says, hey, we had a recession in the past.
I mean, I look at the U.S. leading indicators, and you guys on the high ground on this. What's a leading indicator right now? I mean, what are you looking at? Starbucks coffee sales? What are the tea leaves that are leading in the leading indicator Conference Board statistic?
Well, certainly housing permits are slowing, and that's an indication of the Fed's rate hikes working, slowing down the housing market, which is definitely a source of inflation through rents. We're also seeing consumer expectations be quite weak. New orders for goods are down. A number of the other indicators, certainly the financial market indicators, are showing some signs of stress and weakening. Just about everything is worse within the leading indicators, and it continues to suggest that, yes, we are going to have some kind of a recession. We still think that recession is going to be mild. It's going to be brief, but nonetheless, that's going to be the outcropping of the Fed raising interest rates close to 5% within a few months.
Dana, how do you push back against people who say that short and shallow is the new
Well, I guess you could say, going back to the whole transitory discussion, you really can't blame the Fed too much, right? They didn't know the pandemic was going to last 3 years. They also didn't know that a war was going to break out and cause supply side factors in terms of inflation that haven't dissipated. Still, when we look at food prices, they're still being determined by things that the Fed can't control. And certainly, I think the Fed didn't anticipate as big of a run up in housing prices that are feeding through rents and keeping rent sticky. And so I think that, I'm a little bit more sympathetic to the Fed. And when it comes to recession, it's art as well as science. And I think that, our measures are still telling us, yes, there's going to be a recession. We're seeing momentum slowing. We'll get a GDP data tomorrow, but more importantly, the monthly PCE data, which will tell us what's going on in services. And we'll also see what's happening with inflation. It's still very sticky, and the Fed still needs to raise rates to bring down inflation.
Dana, before we go on with the economic picture, I want to stop for a minute. And we have been talking all morning about the potential for Lael Brainerd to leave the Federal Reserve as vice chair of the Fed to go to the Biden administration. From an economic perspective, does that change the calculus in terms of the differing views on the Federal Reserve?
Well, we need to think of the FOMC as a group of people, many opinions, and when we look at the SEP, the Summary of Economic Projections, and the dot plot, it's a collection of those opinions. Certainly, the dots may shift a little bit left or right, up or down, with one of the governors leaving. But the thing is that you'll have another person coming in, and that person's opinions will also factor in.
Dana, I'm going to get you in trouble here. Are the dot plots of the Fed more informative than the Conference Board leading indicators?
I think they're both important. They give different measures. I mean, the dot plot is essentially telling us where FOMC participants think the federal funds rate is going. Our LEI tells us where we think GDP is going. Two different things, but still both important.
I mean, it's both important and all that. I'm busting our chops, folks, because the leading indicators was religion here a few years back right now. And I agree with you, Dana. It's not that people push it aside, but it's just been overwhelmed by all this other data. Is auto sales a leading indicator? Is used cars prices, things that really matter to our listeners and viewers? Is a dozen eggs a leading indicator?
Well, the thing is that, we try to keep it neat and clean. We have 10 things, but we do always, every year, review what's in the basket of indicators, or the leading indicators index. And we just don't look at that. We look at everything else. Certainly, we're concerned about things that aren't necessarily in the leading indicators, like trade and inventories. And so we're concerned about all those things. A good economist will look at everything and not just rely on one source.
Dana, a lot of people are discussing and debating pretty intensely whether inflation's already slowed to 2% and whether the Fed's already achieved their goal. They've killed off this potential acceleration. Where do you stand on that, especially with the potential for some sort of acceleration with respect to oil prices?
Well, when I look at the components of inflation, certainly energy prices have come off dramatically, but there's still that risk that there's a resurgence once China reopens and there's greater demand for energy. Certainly, as that country looks for more oil and natural gas. However, things that are still sticky that the Fed hasn't been able to tackle are food prices, both food at home and at restaurants and food outside of the home. And then rents. Rents or shelter costs are the biggest thing driving inflation, core inflation right now.
Well, I don't want to interrupt, but this is the heart of the matter. Everybody listening and watching to this is going nuts when you say the Fed can't manipulate out a dozen eggs or the price of a 3-bedroom in Cleveland. You've got a model of under 3% inflation forward. Is a dozen eggs and a 3-bedroom rental in Cleveland, are they going to come down so you can get to your 2.x% inflation rate?
Well, I have less confidence about the eggs than I do about rents. Rents are a reflection of what happened in the past with home price valuations. We see home price valuations for new and existing homes are coming off. They're slowing very rapidly, and that's going to show up in rents ultimately. It takes a while from the peak of where home price valuations were to where you actually start seeing in rents, it could take 12 to 18 months. So if it's around 12 months or so, then we're looking at the spring of this year when we will see material slowdown in rents that will help bring down core inflation and consequently overall inflation.
Before we let you go, there was a story that caught my attention about Walmart. They've been trying to compete with some of their rivals and have been raising the prices, so they're raising the wages for their hourly workers now to $14 starting next month from $12, still less than over at Amazon, Target, and Costco. How much wage pressure is there that you see percolating up, not for necessarily office workers, but for the people who actually go out and make the economy work in day-to-day kinds of positions?
Wage pressures have been tremendous in those jobs where you actually have to physically show up for work. And those are also the industries that are suffering the biggest labor shortages. Anything that's experiential, like going to Walmart or going to the movies or going to a restaurant, those are all the sectors that are still struggling to find workers. And so the first thing that companies do, and we even canvass them, is to raise wages, add benefits, all things that cost them money. But it's what they're doing to not only attract talent, but to keep talent. But unfortunately, those higher wage pressures get pushed down to the consumer, and that's also leaning against what the Fed is trying to do.
Dana, thank you so much. Just a terrific brief. Generous of your time here. Dana Peterson with us with the Conference Board. You know, I haven't looked at the eggs because you and I are fancy people.
I'm not
we go
fancy.
in and I got a limit where I shop of 2 dozen eggs. I don't know about people out there. We all got our stories. Moonshot, summer of 2019, eggs are up 257%. This year alone, 2022 calendar year into the new year, eggs are up 148%. So what I'm paying for eggs, I think, is cheap. Like the price at grocery hasn't gone up as much as wholesale eggs.
Margin pressure, right? Because basically this is the biggest pushback that you get from consumers who go and buy eggs, and they don't want to spend $7 for a dozen. They want to spend $4 for a dozen. So they're going to keep spending $4 even if the price ends up going up for the people who actually are managing that.
No, we should point out there's some medical stuff in here, like the avian flu and all that. This is not just economics and like what we were talking to Ms. Peterson about. There's some medical, flu stuff here.
Do you check your eggs before you buy them? Do you look at each one to see whether they're cracked?
For those of you internationally, we go to the third rail. I check my eggs because they're so often broken.
Which is the reason why it's actually helpful. I always open it up, and then often the ones that are clear, you can just sort of like hold them up and look at the bottoms.
I open them, but do you open the corn and the cob before you look?
That's tricky.
My mother would get so angry at the people opening. She was a Midwest girl.
Yeah. Oh, I know.
And
This is a real huge debate.
And the people, the snide East Coast people, if my corn cob isn't perfect, I'm going to sue someone.
You've seen people actually shear the corn
I don't like that one.
in the grocery store, throw it in the garbage can and toss it aside. Another level of, disrespect. Corn disrespect is something that's very, very hard in our family.
Stay tuned. Farm Journal with Lisa Bramos. Look for that this weekend, 6 a.m. Futures deteriorate. They're going down because they don't want to hear about corn and eggs.
Evidently.
Negative 41 on futures. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and Germany have overcome a disagreement that threatened to fracture Allied unity. They've agreed to give their main battle tanks to Ukraine. Germany confirmed today that it will send 14 of its Leopard tanks to Ukraine, and eventually there will be more. Meanwhile, the Biden administration is expected to announce as soon as today that it will offer Ukraine the M1 Abrams tank. In China, Lunar New Year travel and movie box offices are showing signs of recovery. In the first 4 days of the holiday, the number of trips was up over last year. Meanwhile, the number of movie tickets sold was higher than in 2019 before the pandemic. Google says the U.S. Justice Department is doubling down on a flawed argument by suing the company on antitrust grounds. 8 states joined the federal government in calling for the breakup of the search giant's ad technology business. The suit claims Google has illegally monopolized the digital ad market. Bank of America is rewarding its majority of its employees with a pool of restricted stock. It's an attempt to retain workers in a gloomy economic environment. About 96% of BOA's global workforce is eligible. It's the 6th time the company has offered such stock awards. And Boeing ended the year by posting a quarterly loss. The results underscore the work Boeing still has to do to return its factories to full speed and fully capitalize on soaring demand for air travel. But still, Boeing's cash flow was better than expected, thanks to a flurry of jet deliveries. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
I think there's a mindset within the white business community, and to some extent in the country at large, is that this definition of equity and diversity ought to see money flowing, capital flowing into black entrepreneurs for investment and operating startups of business. And I think if it were easy, you would see more Bob Johnsons, more Michael Jordans, more Magic Johnsons, and Oprah Winfrey's and the like.
He is Bob Johnson of BET, the founder, and RLJ Companies chairman, in conversation with David Rubenstein. This is one of the great American stories. This is a kid who was near youngest of 10 children, and he did that thing that can happen. He was so damn smart as a young kid. He was crowbarred into the University of Illinois on his way to Princeton, and with great acumen onto creating value and money in media. It is David Rubenstein's show tonight. Look for that at 9 p.m. in New York, and Mr. Rubenstein joins us this morning from Chicago. David, Bob Johnson was first in early. Why aren't there more Bob Johnsons?
Well, his view is that the white community, the white business community, gives a lot of lip service to helping black entrepreneurs, but in reality, very little money shows up from the white business community into the black entrepreneurial community. So Bob Johnson was the first black billionaire in the United States, and after he built BET, Black Entertainment Television, he subsequently bought the Charlotte Hornets and ultimately sold it to Michael Jordan, who now owns the team. He's a very wealthy person, very smart, very politically connected, but his view is that the white business community is probably better at lip service than actually reality and helping black entrepreneurs.
To be delicate about it, you live this every day at Carlisle, as we do at Bloomberg. the modern finance system co-opted black innovation. I mean, that's really what this comes down to. How do you see, David, that we nurture this forward to develop more Bob Johnsons?
Well, you've got a 200-year-old problem you're not going to solve overnight. I think there has been a lot of progress in the last few years and much greater emphasis on diversity, equity, and inclusion. But you've got a 100-year, 200-year bias that's going to be difficult to overcome. So there are going to be more Bob Johnsons, and there are other Bob Johnsons. There are more than one black billionaire now, but still relatively small compared to the population.
Well, Bob sold BET to Viacom back in 2001, and he sold it at the time for $3 billion. Can you give us a sense of where the valuation would be, whether he has regrets about selling it there, since there is a huge audience and it has grown since then?
Well, he had two great assets. One was Black Entertainment Television, which he sold for $3 billion to Viacom, and netted maybe for him and his wife about $800 million. And with other things, he became the first black billionaire. Today, cable prices are way down, and cable values are down because of a whole variety of other means that people watch their news and their entertainment. But the other asset he sold, unfortunately for him, became much more valuable. When he sold the Charlotte basketball team, I think he sold it for maybe $300 or $400 million, $500 million. Today, each of these basketball teams in the NBA is probably worth at least $1 billion, if not $2 billion. So he probably sold that asset too soon.
But Bob Johnson is, as you said, still very powerful and very well off as he makes inroads. I'm curious whether he actually believes that there is more of a comfort discussing race among business leaders at this time and how to actually grapple with, as you say, David, a 200-year problem.
I would say that Bob is not wedded to any corporate existence right now, and therefore he can be very free in what he talks about. And he would say, no, there's really good lip service being given, but he doesn't really think the white business community is as interested in helping black entrepreneurs as the rhetoric is. So he would say it's going to take a while for you to have black entrepreneurs like him more prevalent in the United States.
David, I'm absolutely fascinated, and particularly with your study of history and your philanthropy to America and some of the documents you've brought in and such. You mentioned the media companies coming out of the Bob Johnson era that are now basically flat on their back with technological disruption. How does Carlyle play that? When you sit around with your young Turks at Carlyle and you say, how do we be opportunistic in media? How do you actually go through that process?
Well, the kind of things that we looked at Carlyle years ago, cable TV properties and things like that, are just not as highly valued or as attractive to buyers. So you have to find new areas, new technology areas, and try to get in on the ground floor of them. But the kind of things that Bob Johnson built, BET, is just not worth as much today because people don't really look at cable as much as they used to. They look at other means and streaming means. But a cable channel like BET today, I doubt if it would get anywhere close to the value that he sold it for.
I mean, not that I need to know your last phone call with Mr. Iger and Disney of what they need to do, but David, you and I have never seen technological disruption like streaming. Okay, so private equity can run from that. What does the rest of the finance industry do? Where are they in 5 years?
Well, no one, of course, can know for certain, but I think right now a lot of technology that's being developed in Silicon Valley and other parts of the country, you have venture capitalists and you have what's called growth capital investors putting money in, and they're making bets. They don't really know which technology is going to take off, so you make several bets. Nobody would make just one bet in technology for the future. Who could have predicted streaming 10 years ago? No one, probably.
Yeah.
And as a result, everybody is wary of just making a bet on one technology. We just saw the other day that Microsoft is making $1 billion. We just saw the other day that Microsoft is making a multi-billion-dollar investment in essentially an artificial intelligence startup. Who would have predicted that a couple years ago? And so no one really knows. And the theory is make as many bets as you can that are reasonably intelligent, and one of these technologies probably will take off.
One interesting aspect of this is the new asset classes that have sprung up, and you were talking about the potential for sports teams and Bob Johnson. That's long been established. There was a Financial Times story today talking about how music financing is the next big thing, and actually having futures attached to different streaming rights. So actually cling onto the IP of some of these musicians. Are you buying that?
Well, I do think that music technology has changed dramatically, and now the great recording artists are selling their programming or their recorded albums and so forth and songs at great valuations, because now through streaming and other devices, people will be able to pay a little bit of a tiny fee, and you'll get to hear all the music you want. And as a result, I think it's a changed the entertainment business completely and changed the record business completely.
Can you see David Rubenstein taking a meeting with Justin Bieber?
100%.
I could just see it.
Absolutely.
Well, we were involved in that for a while.
Okay, well, thank you, David Rubenstein. Thank you so much with Carlisle. And, of course, the news here that Mr. Bieber, some kind of reports that he's moving his catalog out. The number 200 million has floated to the surface recently.
And this is sort
That's
of
a
new.
lot of Biebs.
It's sort of new and also sort of not. Remember Bowie bonds back in the day?
Yeah, well, they started it. Oh, David
Securities?
Bowie started
David Bowie
it.
was
Oh,
a
no.
pioneer with this. In a lot of ways, he was a pioneer.
Yeah, and that's, of course, becoming more often the case with the cash flow persistency of some of these copyright items. David Rubenstein with Bob Johnson tonight of BET. Really, really interesting to say the least. I think we've got to look at futures negative 44, deteriorating. We're in earnings season. We're going to see that. But I would really suggest to people it's not just the equity markets. There's a lot going on out there in terms of beginning to model in off of what we'll see tomorrow, which is just under 3% GDP.
Have we gotten to a point where bad news is bad news? And I mean necessarily, glass half empty, but in terms of a negative view on the economy will bleed into equity valuations. We're seeing both bond yields lower and we're seeing stock futures lower. And we've seen that kind of correlation that's more traditional kind of reassert itself a little bit more in a couple days this year.
We've seen Evercore ISI reaffirm sub 3% inflation coming. Dana Peterson at the conference board, sub 3% inflation coming. And as an expecting force, the markets will begin to look out to that. And, the days are getting brighter every day. I know it's January, but March will be here in a cup of coffee. And I'm going to go to, or a cup of Tang, I should say. I'm going to go, Lisa, last meeting of the summer, July 26, at the Fed, where they'll be confronting, according to some of our guests, some serious disinflation. And that just leads to endless mysteries.
Are you on short and shallow camp?
Am I short what?
Short and shallow camp?
I don't play the game. I've been so humbled and so wrong over the years about gaming NBER recessions, which are really after the fact in their analysis. I do suggest that what we saw in 80, the Volcker years of two separate and distinct recessions close together, was very unusual. In these unusual times, it gives me some humility. John Farrow's in London. He's going to migrate forward with some important conversations, much more, on Bloomberg Radio and Bloomberg Television today. Please stay with us. This is Bloomberg Surveillance. Good morning.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnsons, more Michael Jordan, more Magic Johnsons, and Oprah Winfrey's and the like.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. We started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is like you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct to consumer. Like I want to build out a true consumer empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them, and so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value, and the kind of transparency that they want.
Are you seeing a labor shortage right now, and what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
Live from the City of London for our audience worldwide, equities at session lows. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, Microsoft are raising gains as cloud sales are set to slow. Better news out of Europe as the German outlook improves, and a top Fed official in line to run Biden's Economic Council. We begin with the big issue, headwinds growing in Silicon Valley.
The big thing for this week is really tech earnings.
For the big tech stocks.
Big tech, we saw the start of it last night.
The message we're getting from this particular sector is that growth is slowing.
Microsoft talked about that last night.
Microsoft is talking about a weak global backdrop.
They haven't guided in this release, so we need to hear guidance.
The cost cuts can only get you so far.
No one was going to do backflips over these numbers.
It's all the other companies that have yet to report that have to deliver bad news.
But relative to the fear, way better than expected.
We're continuing this process of reevaluating valuations.
Some of the tech names, have become a lot cheaper than they were.
But I'm not sure that that's going to continue. The multiples there are still too high.
Let's not break out the champagne glasses at this point.
Joining us now to discuss is Nuveen Sarah Malik and Keith Lerner of Truist. Sarah Malik, I want to come straight to you with a line from Julian Emanuel of Evercore from last week. He said the market's New Year rally has concluded. Sarah, has the market's New Year rally concluded?
I think the market did come into the year pretty optimistic. If you look at valuations, they were pricing in a soft landing, and that's about the best case scenario for this year. Just this week alone, we have two macro issues with the debt ceiling negotiations and PCE as an overhang. But the real issue for the year is earnings, and you're seeing that with Microsoft. Revenue growth going forward is at risk. Revenues are coming in at about 5% year over year this quarter. I think in the face of a slowing consumer and manufacturing data, revenue growth has a hard time holding up overall, and that means earnings have downside for 2023.
A shout out to Guggenheim, who are on top of this story with Microsoft over the last couple of weeks. Just a few weeks ago, giving the stock its first sell rating in more than 3 years and saying the following: while most investors see Microsoft as a large, stable business that can weather any storm, it does have vulnerabilities, some of which could be exacerbated by this macro slowdown. I want to come to you on that, Keith. You like U.S. large caps. What do you make of that, though?
Well, we're in agreement. We've been underweight the technology sector for most of last year, and we remain underweight. Jonathan, if you think about it, first of all, the rally this year really is just a bounce back from the sell-off in December. On the S&P 500, we were at 4,100 in mid-December. We're still below that. And to go with tech specifically, people have to remember, if you zoom out over the last 10 years, this sector has outperformed, especially the FANGs by, but they were up about 600, 700%, so almost triple the overall market. And then if you think about what happened during the pandemic, the pull forward to earnings was really concentrated in tech. So it's not a surprise that there's an overhang there. And we think as we move into the next cycle, we don't think that tech is likely to be the leadership. And as mentioned earlier, the sector is still trading at more than a 20% premium. So we remain defensive in that area.
Keith, where do you see leadership emerging?
It's funny, you mentioned that. I was on a Bloomberg podcast last week, and we would say, hey, will the real leadership please stand up? Because there's a lack of sector leadership, and that's part of the challenge. The tech sector and the growth sectors are the big part of the overall market, and to make a much headway from here, you need them to participate. And in our view, the upside is somewhat capped. So where are we looking at below the market surface, Jonathan? We've talked about this over the last year. We've been pounding the table on the equal-weighted S&P. The average stock in the market is looking a lot better than the overall market, which is being dragged down by tech. That index just made a fresh relative high to the overall market. We would stick with that as far as relative opportunity. But overall, in our portfolio, is still remaining somewhat defensive.
Sarah, what's your take on that?
I agree in the sense 2 areas I like in equities, and that's defensive and quality. So not necessarily a sector, but areas like dividend growers, companies with lower volatility, some income component. They're more defensive, growing their fundamentals, but also providing a growing income. These are areas that should be more resilient in this economy. And then go outside of equities. I think you can get equity like historical returns and fixed income, again, focusing on quality, investment grade fixed income. A lot of the pain of rate hikes is priced into the fixed income markets, and the total returns to us look pretty promising.
I'll pick up on that fixed income story in just a moment. 25 minutes, 26 minutes away from the opening bell. Equities are lower by more than 1% on the S&P. On the Nasdaq 100, down by 1.7%. Tech earnings throwing cold water on recent gains. Microsoft and Texas Instruments delivering the same message. More pain ahead. Ed Ludlow joins us on the West Coast with more. Morning, Ed.
Yeah, good morning. Both stocks pushing lower in early trading. Microsoft's interesting because it originally rose on the commentary around Azure and its cloud business, and then it fell on that more granular commentary on the earnings call about its cloud business. Amy Hood, the CFO, saying from the fiscal second quarter to the current period, we'll see a drop of about 4 to 5 points in terms of that growth at the cloud unit. But the point was, despite performance in the quarter just gone, the world is changing and that commercial business is softening. Similar picture for Texas Instruments, right? Slightly above or in line with expectations in the quarter just gone, but a pretty tepid forecast, a range where the midpoint wasn't really in line with what the street was looking for. If there was a bright spot from Texas Instruments, which is one of these chip makers that makes the more basic analog and embedded processing units, it's that they did say they saw more weakness in all of their end markets apart from automotive. And I think the street was waiting for Texas Instruments to see if that automotive segment too would slow down. Both companies fit the narrative now that going forward, would we continue to see revisions downwards in earnings expectations for this technology sector? Remember last week, John, we were talking about how going into the first 3 months of 2023, we thought we might be coming out of a sort of earnings trough for the technology sector. But remember, broadly speaking, consensus is for information technology stocks to see EPS drop by around 8% from the same period a year ago. What changes that? Not a lot, it seems. It seems like we're on a downward path right now.
They seem to be very transparent about that, Ed. The leadership of companies like Microsoft. I think Satya Nadella has been pretty transparent, hasn't he?
Yeah, I mean, relatively so. I mean, guiding quarter to quarter is one thing. We didn't really sort of get that full year guidance, although looking at some of the headlines that crossed the Bloomberg terminal during that earnings call, growth to slow in the commercial business for the rest of the full year was the kind of headline that jumped out at me, in lieu of sort of specific full-year guidance, which in Texas Instruments' case, by the way, they don't tend to give full-year guidance anyway, but the street was looking for sort of confirmation that in Texas's case, their full-year sales would drop by 8% as well. So the commentary, the color, matches the math that the street seems to be doing.
Ed, great to catch up. We'll touch base a little bit later in the hour as we talk Tesla. Back with us, Sarah Mallett, Keith Lerner. Keith, I want to come to you. Keith, we're up by what, 8% or something like that on the Nasdaq 100 year to date. Why has tech rallied so hard to start 23?
Well, because it sold off a lot last year. What we saw, Jonathan, in December is we saw really a significant pickup in fund selling, especially the areas of the market that were beat up the most. Think about like the ARC ETF. There's a lot of talk about how that's up 25% year to date, but it's flat since December. So these things just got oversold in tax loss selling. That tax loss selling subsided, and we had to bounce back. And January is a big mean reversion month, especially after you've had a year like last year. But we're skeptical that's new leadership in the market, especially with the Fed continuing to take away some of this liquidity. And the other thing is, the general market. There's a lot of discussion about earnings. In our view, you don't even need to have a negative earnings view to say that the market's risk reward is not that attractive, because you're trading at around the 17.5 multiple for the market. Interest rates are much higher than the long-term average, at least the last 10 years. The market is above average. So just at current forward estimates, but as you hear from Microsoft and other companies, it's asymmetric downside risk. We don't think those estimates are going up. So let's say you go down to 210 or below, the market's actually trading at a higher multiple. And if you look at the 10 years before the pandemic, the highest the multiple got was around 18 to an 18.5. The question I would ask is, do you deserve an above average premium in this market when you have above average risk? Our answer is no.
You mentioned the risk-reward proposition. We're told the risk-reward proposition is better this year in fixed income from this starting point. Sarah, you mentioned that. Walk me through the argument for fixed income. And can you tell me how far you're willing to take this when a company like Citi has come out in the last 24 hours and said, buy triple Cs?
Well, first of all, going back to last year, the typical 60-40 diversified equity fixed income portfolio did not work well at all. I think that correlation is much more in investors' favor this year. Just looking at rate hikes going forward, about 50 more basis points expected from the Fed. So that's starting to move behind us. You can start to increase some of your duration in fixed income and get strong total returns in it, as Keith mentioned, without a lot of these heavy macro risks that are going to hit equity. So earnings risk in some of these other areas, the consumer slowdown and that impact on revenue growth and all of that with equities considering their valuations is less attractive. So it goes back to risk reward in fixed income, much lower risk for much higher reward. I'm on the quality side. I think going into a recession, you want to focus on companies with strong balance sheets that can cover their debt service. So quality fixed income like investment grade. There are some interesting areas of high yield though, because energy is a big component of high yield fixed income, and energy companies should continue to have strong fundamentals.
So on the other side of this, Keith, I can see here that you've downgraded high yield, investment grade, and leverage loans. Keith, why?
Well, because we don't think they're embedding much risk of a recession, not even much of a slowdown. And we went to an overweight to fixed income at the end of October when the interest rates were around 4%, and we went long duration, and that's worked out pretty well. But our main message this year is keep fixed income simple, stick with high quality. Look at high yield spreads. They're back to where they were in the middle of last year. Look at triple Bs. They've collapsed. So the market right now is pricing in a soft landing, and maybe that is a potential, not our base case, but it's already being priced in. If you have any type of recession risk, you're not even baking in any of that. So we would just, we think there's risk of spreads widening later this year. And again, we would keep it simple, and we're barbelling kind of short-term rates, which you look at the 2-year, closer to 4%, with things, longer than the 10-year, because of that duration would help out if those recession risks start to materialize later in this year, which is our expectation.
Sarah, let's build on that and look at the data as well and compare what we've seen take place in the market compared to what we've seen take place with the economic data. The PMIs in America are sub 50, and in the face of that, high yield spreads are getting tighter. Sarah, can you give me the argument as to why you think the data improves, or perhaps it goes the other way? I'm just wondering how that reconciles. That divergence surely can't maintain through the rest of this year.
I think data going forward is at risk. So manufacturing data already showing that it's in contractionary territory. The next two shoes to drop could be the consumer and the labor markets. I think consumer continues to weaken. You're seeing that already with the consumer dipping into their savings rates to keep spending. They're doing that because the employment market is strong and wage inflation is strong. I think when you look at employment markets, they tend to crack right about when a recession starts. So we can't really hang our hats on that strength there. In fact, you will see payrolls continue to moderate going forward. That'll eventually unwind the consumer, and that's why this earnings story is so fragile. So that is the overall risk. Economic data continues. Reason being that we've had all of this Fed tightening, and even though the Fed is likely to pause in the near future, the impact of that tightening has not really shown its impact on the economy, and that's what we need to see play out in 2023.
So, Sarah, where does that leave a long in credit in the face of what you expect from the economy?
Depends on your time horizon in the sense that we were also overweight fixed income starting at about the middle to late last year. So if they have had strong returns going forward, but again, where are you getting the best risk reward going forward? You can still get nice long-term returns out of fixed income if you were buying in today, which is why we're not downgrading it. But you do need to be more selective, which is why last year we were overweighting high yield and now we've moved up to investment grade. Just one other area I do want to mention, it's kind of in a real assets equity group, is listed infrastructure. This is a nice recession resilient asset class. The backing of it is waste management and utilities and midstream pipelines. That's an asset class we also really like because it tends to be recession resilient and it had poor performance in 2022.
Sarah Malik, Keith Lerner, sticking with us. We need to pick up on the Europe story as well and the international rally. Equities right now down more than 1% on the S&P 500, on the Nasdaq down by 1.6%. Microsoft taking a dive. It's the turn of Tesla with earnings a little bit later after the close. Coming up, fresh data out of Europe, continuing to ease recession fears.
Companies are telling us they are optimistic regarding the next 6 months, and that suggests overall we will avoid a technical recession.
That conversation up next.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
The most important risk for the German economy was a gas rationing scenario. That risk is off the table now due to the mild weather. Gas storage is full. Companies are telling us they are optimistic regarding the next 6 months, and that suggests overall we will avoid a technical recession. We still expect a shrinking economy in the first quarter, but then an improvement towards the summer.
Things are looking up for Germany. The latest IFO survey showing 4 straight months of improvement in business expectations, with recession looking increasingly likely to be averted. Guy Johnson's been following this story. Guy, talk to me about the data. It's getting better and better.
It's still not great, though, is it? So I think you just need to stand back and look at this number in isolation. Yes, the direction of travel is more positive, but we were pricing in a horrible scenario. Europe was going to grind to a halt. There was going to be rationing. It was going to be really, really bad. So I think we priced some of that out. And Fuchs was talking about that. He thinks we avoid a technical recession. It's still going to be difficult. So we've kind of priced out the worst case scenario, but we seem to have gone from worst case scenario to we're off to the races again. And we seem to have gone and done that very, very quickly. And a lot of people are now beginning to question that. So Emmanuel Cow over at Barclays is talking about the European rally, the equity rally having been driven by short covering. He doesn't think retail, he doesn't think sort of larger pension funds are participating in this. So I think we need to take everything that is happening right now, maybe with a pinch of salt.
I asked that question of Patrick Armstrong of Plurimi, who was short the DAX. He said that was painful. He took that short off. And I asked him pretty directly, I said, do you think that's what's taken place? Is this shorts coming off as opposed to longs going on? And for longs to go on, you'd have to believe that we're going to get a real recovery here. Said it a few times, Guy. I'd love your thoughts on this as well. There is a difference between recession and stagnation. We're talking about stagnation. There's a difference between stagnation and expansion. Are we going to get the latter?
Well, the data are pointing to stagnation, aren't they, at the moment? They've gone from being horrible, as I say, to being kind of stagnant. Do they move on to the next phase? And I think that's the big question. But I think the risks are definitely there. I'm going to be speaking to Sebastian Rader a little bit later on from Bank of America. He's the chief European equity strategist over there. His view is that we go down from here in terms of the equity market positions. He sees a significant and aggressive tightening coming through from the ECB, and you're getting that narrative coming through. So that's risk number one. Germany's sending Leopard tanks to Ukraine. If you think that conflict is over, if you think that risk has gone, just look at the front page of all the German newspapers today.
I agree with you. Guy Johnson on the latest. We're going to touch base with Anne-Marie Hordern a little bit later this morning on that story. We'll touch base with Guy a little bit later this morning as well in about 42 minutes' time. Do not miss that conversation with Guy and Alex Steele a little bit later on what's taking place in Europe. Sarah Malik, Keith Lerner back with us. Keith, I want to go to you. The Euro Stoxx 50 year to date is up about 8 or 9%. Emerging market equities year to date up about 8 or 9%. Keith, you don't like either. Why?
Well, we've been big bulls in the U.S. for many years, but I will say you have to acknowledge a couple of things. You know, why has this market turned so quickly? It's because you had a condition of really cheap valuations, you know, very negative sentiment, and then you had two outlier events that were unexpected, right? As you just mentioned, you know, there was a lot of discussion that winter is coming. Well, winter never came in the way that people thought for Europe, so that was very beneficial. And so that was the first punch. The second punch that helped out was, you know, China basically ripped the Band-Aid off of COVID. So, you know, Europe's very leveraged to Europe as well, and I think that's helpful. There was a stat, Jonathan, I just saw this week that, you know, in 2019, the amount of tourists from China to Europe was about over 20 million. Sorry, the amount of nights stayed was over 20 million. That moved down to about 1.5 million at the end of 2021. So just think about a lot of these folks that were locked down, you know, traveling to Europe and also, you know, spending on services. So I think that's helped out. So at this point, we're looking at that area closely. You've had a three standard deviation event where EFA has outperformed the U.S. by the most, or one of the most in the last 30 years. So our point of view is, I think there is some tailwinds because of the, you know, you have an opening of China that will help Europe. I do think the long-term structural risks are still there. So we're looking at this point is it's run, waiting for consolidation, and maybe becoming less underweight over time if we get that that kind of pullback. Again, this is more kind of a relative trade since we've been such, you know, so overweight the U.S. And I think that's what's happening, Jonathan. You see in the fund manager survey last month, the allocation to the U.S. collapsed, and I think you are seeing some asset managers just shift after, you know, a 10-year period of underperformance in international.
Sarah, where are you on this issue right now?
I agree with Keith. We came into the year with 3 short-term positives for Europe: the valuation argument, the mild winter, and China reopening. But there's 2 long-term issues we still need to deal with. They still have the same inflation problem that the rest of the world has, and their economic growth is not starting from such a strong level like the U.S. And I think that does put them at the risk of not only not avoiding a technical recession, but even potentially going into a stagflationary environment. So those are the long-term issues, and I think a lot of the positives are priced in. If I was going to play non-U.S., what I'd be looking for is a better entry point for commodities. I think that's a broader play for global growth and non-U.S. growth and China, so you're not just based on Europe. Other thing I like about commodities is that they're a good play into renewable energy. We're going to be producing more renewable energy in the next 5 years than we have in the last 20. So things such as copper, where I expect demand to double by the year 2035. We've been underinvesting in copper. U.S. production is down by half in the last 25 years. That's a very tight industry. I think you could look for a good entry point.
Sarah, do you have a preference on whether it's the underlying commodity or the producer of that commodity?
I mean, I'd be looking at, you know, companies like FCX, which is a producer of copper, looking for companies that have sustainable copper mines that can produce copper in a more resilient, efficient way going forward, and that will feed into that demand, which they continues to strengthen going forward, especially through the next decade plus.
Keith, final word?
Well, I think Sarah's point is a good one. We've been more overweight energy, the sector specifically, and also industrials. Think about the increase in defense spending that you're going to continue to see in Europe, even though there's some issues here domestically. I think the defense sector overall is one that should benefit secularly from this strategic battle with China, but also the increase in spending in Europe.
Hey, Keith, great to catch up as always. Same to you, Sarah. Sarah Malik there and Keith Lerner on this market. This market not great this morning, that's for sure. Good morning to you all stateside. Equity futures negative about 1.1% on the S&P 500. On the NASDAQ, we're down about 1.7%. Microsoft, the big victim after the close, with weak guidance for cloud and cloud revenue. We'll pick up on that story in a couple of minutes' time and push ahead as well to Tesla after the close. Tesla earnings signaling a slowdown ahead, potentially, with the car company cutting prices over the last few weeks. The results continue to roll in with Tesla after the close. That conversation still ahead with Colin Rush of Oppenheimer.
On the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Futures near session lows on the S&P. We're down 1%, on the NASDAQ by 1.7%. Let's get you some morning calls. First up, BMO downgrading Microsoft to market perform, seeing limited upside until its cloud business starts growing again. That stock is down 3.5%. Next up, Goldman upgrading Philip Morris to buy, 120 price target, seeing a positive risk reward and improving growth outlook. We're positive there, 1.9%. And finally, Morgan Stanley naming Tesla as top pick in the EV sector, pointing to the company's superior balance sheet, profitability and free cash flow generation. That stock negative going into earnings by 1.7%. Coming up, Tesla earnings on deck. Oppenheimer's Colin Rush expecting mixed results, with competition heating up and margins proving better than feared. Your opening bout just around the corner with stocks down more than 1%.
we're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
This is Bloomberg.
Microsoft went on this market this morning. Good morning to you. Equities down, going into the open by 1.1% on the S&P 500. On the Nasdaq, down by 1.66%. More tech earnings after the close. Looking ahead to Tesla, going into the open. Futures looking soft here on the Russell. We're down 0.8%. There's the opening power switch at the board and get to the bond market. Yields shaping up as follows, going into GDP and jobless claims tomorrow morning. On the 10-year, 354.07, yields unchanged on a 10-year this morning. Euro-dollar not doing much off the back of better than expected. German business confidence, 108.84 on euro-dollar. And crude, just about holding on to $80 and about 36 cents. Positive there by almost a third of 1%. That's the cross-asset price action about 20 seconds into this one. Equities lower by more than 1% on the S&P. On the Nasdaq, down by 1.6. These stocks to watch at the open. It's Microsoft, the company delivering a bit of a grim outlook. The CFO, Amy Hood, saying the following: we are seeing customers exercise caution in this environment, and we saw results weaken through December. We expect third quarter growth to decelerate. And Abby, it's that word decelerate that gets our attention.
Yeah, it certainly does. It's getting the stock's attention for sure. And it's interesting, John, because yesterday in the initial reaction to this stock, the report, we had the shares higher on that cloud business. But then as details were given, especially that growth, we now see the shares down, the worst day since January 4th of this year. And you can see here that the last quarter, 38% year-over-year growth. Initially, investors took that as a good thing, but it's that outlook for this current quarter of 33%. If you take a look at that relative to 48% growth in September of 2021, a 15% deceleration. Now, it's interesting because Satya Nadella, the CEO back last week at Davos, was talking about the idea that there's a normalization out of the pandemic. The question is, what growth number will investors think is acceptable? This, of course, has weighed on revenues overall. We're looking at the slowest revenue growth for Microsoft going back to 2016, growth of just about 2%. Nonetheless, it's not deceleration, so that may be a positive thing. It's not just about revenues, though, John, too. We have an issue around profits. The EBITDA margin slid. It's down more than 7% from its September 2021 levels, so we're seeing some issues there. Technically, the stock, though, John, it's interesting from a long-term perspective, looks as though it could have found some sort of a bottom. We'll, of course, find out, but when you take a look at valuation, 23 times next year, more than 30% bottom line growth for managers who have to own tech. At some point, this may be a stock that they're going to look at. Not exactly a kitchen sink quarter here, but enough bad news maybe out of the way that you'll see some folks nibble, maybe even later today, John.
Stock's down 3%, a little bit more than that, about 2 minutes into this. Abby, thank you. Broader market down by 1.2% on the Nasdaq, down by almost 2 percentage points. Texas Instruments delivering a similar script. The chip maker failing to provide investors with any clarity on sales. The CFO had this to say: arms in the air, I wish I knew. Customers have done what they've done for decades. They've built a little too much inventory. We'll see how long that takes to work itself out. For more, is Kelly Lyons. Hey, Kelly.
Hey, John. Well, it's no surprise that one of the largest chip makers in the world is feeling the chip slump in a big way. They actually reported their first decline in sales going back to 2020, a decline of about 3.4% for revenue, even though that did come in ahead of expectations. And for the quarter they just reported, profit came in ahead of expectations too. But when it comes to their guidance at the midpoint of the range they gave, both the top and bottom line came up short of analyst expectations. The basics here, John, is that Texas Instruments may have the broadest range of products in the industry and the longest list of customers in the industry, but that doesn't matter so much when those customers aren't demanding as many of those products. Instead of ordering new chips, they're focused on reducing their stockpiles of used ones because they have too much. This is a very common post-pandemic story. So that has led to weaker end demand for Texas Instruments in almost all of its end markets, the exception being automotive, which is about 21% of its revenue share, but everything else, they said, was down between 10 and 20%. One analyst over at BMO this morning said it's only a matter of time before there's weakness in automotive as well. At Citi, they're talking about broadening weakness, saying it appears gross margins could drop another 200 basis points quarter on quarter. What I do find interesting on that point, though, John, is despite those pressures, Texas Instruments executives say they aren't planning to reduce headcount in order to cut costs. The reason why, the CFO says, because the company didn't get ahead of itself and hire a lot of people over the past 2 years. Their headcount has actually stayed remarkably steady, so that is something that differentiates them from the other technology-oriented companies that we are seeing with layoff announcements almost each and every day, John.
That's a bit of shade. Everybody else, it seems, over in tech. Katie, as you say, Katie, thank you. That stock is down 1.3%. Tesla leading the next round of tech earnings. Those results coming after the closing bell as investors' concerns keep piling up. Ed has more. Hey, Ed.
Yeah, good morning again, Jonathan. Well, we see the stock lower 1.9%. Both JP Morgan and Morgan Stanley cut their price targets on the stock ahead of earnings, basically saying that they're looking at those price cuts, particularly in China, and what that will do, not necessarily as a lever and driver of demand, but what it means for profit going forward. Analysts expect adjusted earnings of $1.12 per share on $24 billion of revenue. That would represent sequential and year-on-year growth, but they go straight to gross margin, right? Tesla is kind of the industry leader when it comes to gross margin, which analysts expect to come in at 25%. What does the impact of those price cuts do to that gross margin? You know, remember Elon Musk has talked quite recently on a Twitter Spaces on the issue of demand. And, you know, I'm paraphrasing, but his question that he posed was, do you want us to demonstrate unit growth and use price cuts as a way to drive volume growth, or do you want to grow slowly and steady? His conclusion would be that Tesla should grow as fast as they can without putting the company at risk. What I would say when it comes to Tesla's quarterly earnings, Zach Kirkhorn, the CFO, tends to step up, give granularity about what Tesla is doing with regards to the supply chain, the management around the bottom line. Sources have been telling me recently, go back to that last quarter of deliveries. Internally, there's still frustration over the number of vehicles that were in transit, therefore not delivered to customers, and therefore not booked as revenue. So that's still an issue we're going to be monitoring for as well.
Just quickly, some clarity. You touched on it a little bit. Are we going to hear from Elon later?
I believe we will. You know, the context here, Jonathan, is that Elon Musk has told investors in the past that he doesn't believe he needs to attend earnings calls and that there are better uses of his time. But following those statements made 18 months ago, he has continued to attend the earnings calls. He has been in San Francisco courthouse, of course, this week around the 2018 Take Tesla Private tweet hearing, which is a jury trial. And he then flew to Nevada 24 hours ago for the announcement of a $3.6 billion expansion of their facilities there. So there's nothing that tells us he won't be on the call, I don't believe.
Looking forward to your coverage a little bit later. Ed, on the West Coast, on top of Tesla. Oppenheimer's Colin Rush looking ahead to Tesla results and saying the following. The core issue is whether the company can continue to grow while maintaining premium margins. We anticipate mixed trading on shares as EV competition begins to play out and expect updated margins to be modestly better than feared. I'm pleased to say that Colin joins us right now. Colin, let's start there. The price cuts, and thank you for being with us, by the way. The price cuts of the last couple of weeks, are they a bigger problem for Tesla or their competition?
I really think this is a proactive move on Tesla's part to make it very difficult for their competition to ramp. They have a structural cost advantage because they've designed cost out of the vehicles, and they've got a volume advantage. We think they're pressing that advantage now to make it pretty painful for competition. And I think the real question for investors right now is what's the normalized margin going forward through 2023? I think the strategy that they're looking at is coherent, and there's a lot of investor concern around competition here. But what the normalized margin and cash flow looks like for this company, through 23 and 24 as we go through this adjustment period of actually having competition for the first time is really the heart of the matter for the stock.
Colin, what do you think it is?
I think it's going to be a little bit better than feared. We think there's some folks betting on, margins being in the low 20s for 2023. I think with the commodity tailwinds, some of the supply chain things that you were just talking about on the program with components becoming more available, plus some of the sell-through and utilization on the new factories, point to margins being a little bit better than feared. And I'm not sure we're going to get to the street's at 26.5% right now. I'm not sure we're going to get all the way there from a gross margin perspective. But if we're in the 24-25% range, I think the stock rallies from here.
Colin, given what's happened with price, has that changed your view on what you think the growth numbers are going to look like for the time being, going out several years?
I don't know. So there's a lot going on here. I mean, obviously, Elon's brand has taken a big hit with the Twitter acquisition and some of the behavior around that. We downgraded in December around just the rounding error or the incremental customer being a little bit more cautious around buying a Tesla just from a brand perspective, and that can start to shave some of the pricing power that the company has. And so, as we look at this, there's certainly demand for EVs. We think there's a very big market. There's an awful lot of consumer interest. The total cost of ownership advantages, both in the U.S. and Europe, are still pretty meaningful. And so we think there's sell-through at the right price, but I think people are being a little bit more cautious with the, potential recession. We've got a lot of layoffs and, really, pretty decent jobs where folks could be looking at a premium vehicle purchase. And so I think this year is an adjustment year. We're going to find out kind of where the levels are as we get into the first half of the year and what this looks like. The other thing to consider is really the China demand. We've gone through a change in the subsidy regime in China. That adjustment is starting to be felt from an inventory perspective. There's also a little bit of a slow start to the year with the Lunar New Year being early and some of the reopening. And so there's some inventory flush that needs to happen on vehicles and batteries in China in the first quarter here. And as we get into the latter part of February and into March, we'll get a better feel for how the year is going to progress in China. And that will matter for Tesla from a unit perspective.
There's also, Colin, the valuation issue as well. Rates have gone to 450 at the Federal Reserve. That makes a monster difference for companies like this. And Colin, I'm just wondering from your perspective, how one should value this company. I know what the bulls think. It's a tech firm. I know what the bears think. It's just another auto company. What do you think?
Yeah, we've been firmly in the tech company camp for a very long time. We think that these guys are cycling technology well in advance of peers. They're innovating on the material side, both at the battery level as well as the vehicle level, structurally on the cars as well as in the powertrain. But additionally, around the perception and the navigation system, we think they've got real significant advantages around miles driven and learning cycles on that. And so we think you deserve a premium multiple here. What we're concerned about is the adjustment of the auto industry and Tesla's place in it and potential distraction for management. What you were talking about, Elon being on the call tonight, we would expect him to be here. I think he needs to show that he's attending to what's going on at Tesla and isn't distracted by a number of other things that he has going on his personal plate. And so I think he'll attend and be very full-throated about the positioning that Tesla's at and how they're approaching the market strategically. And so we think that ultimately there is going to be a premium as we look at where rates end up and what multiples really are appropriate given the interest rate environment. We'll come back to that. Right now we don't have a price target given our perform rating, but we think there is a premium multiple and a tech multiple that is appropriate for this company as we get a better sense of what their earnings power really looks like.
Colin, just finally, there was some chatter about capital returns. What do you think that looks like this year, if at all?
I don't think they're going to do, any sort of dividend, return to investors at this point. There are so many opportunities for them to invest cash. We think that they will take those opportunities to grow the business and accelerate some of the cost reductions within the platform. And at some point, they may think about dividending cash out. But I think there's too many opportunities for them to invest right now to really think legitimately about a dividend.
Colin, this was thoughtful stuff, as always. Colin Rush there of Oppenheimer on Tesla. The numbers coming up after the close. Coming up on this program next, President Biden eyeing a top Fed official to run his economic council.
policy is going to need to remain sufficiently restrictive for some time to make sure it gets down to 2% on a sustained basis.
That conversation, up next. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, there are half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnsons, more Michael Jordan, more Magic Johnsons, and Oprah Winfrey's and the like.
That said, inflation remains high, and policy is going to need to remain sufficiently restrictive for some time to make sure it gets down to 2% on a sustained basis.
President Biden looking to add the Fed's vice chair to his team. Bloomberg reporting Lael Brainerd is a top contender to become the new head of the National Economic Council. On top of that story, Bloomberg's Anne-Marie down in D.C. AMH, walk us through what you've learned this morning.
Well, John, what we know now is that she is not just in the running, but a top contender, as you mentioned, to take on the job of the director of the National Economic Council. We should note no decisions have been made, and there are other names that have been thrown around, like Gene Sperling, like Wally Adeyemo. But right now, what you potentially could see in the coming weeks is that the Fed's #2 becomes the #1 economic voice in the West Wing. This is on top of a little bit of a shakeup at the White House, which is pretty much natural when you have, after a midterm election and 2 years of an administration. We do know that Ron Klain will also be exiting, and as well as Brian Deese. And that's why Lael Brainerd's name is getting a lot of attention this morning. But Jonathan, no one is walking out the door before the State of the Union on February 7th.
MH, great reporting, as always, on the ground down in Washington, D.C. I just want to squeeze this in, Anne-Marie, just briefly if we can. It's an important question about the tanks that Ukraine is finally receiving. Anne-Marie, your view on that. Is that an escalation? 6 months ago, would this have happened?
It would not happen 6 months ago, but when you talk to the Ukrainians, and I recently talked to an official that advises the defense ministry, he says that this has always been the way it was working with the West. They would drag their feet in their words, but then they would come to the realization that this is what is needed on the ground. And for Germany to act, they're acting alongside the United States. Russia will move any move as an escalation, but if they're going to act together, Germany feels much more comfortable sending those Leopards, and the U.S. will be sending their tanks as well.
Anne-Marie, great work down in D.C. Joining us now is DWS Group's Greg Staples. Greg, I just want to touch on the story that AMH went through a little bit earlier on the Vice Chair of the Federal Reserve in line to move towards the administration. No idea if that actually materializes or not, Greg. Would that leave a big hole on the Federal Reserve Board for you?
I think it would leave a little bit of a hole. I think, of course, what's going on right now is you float a lot of names and you get some sort of political reaction. I think it's the reaction to the floating of names that ultimately determines whether Lyle Brainerd or Gene Sperling or somebody else takes that role. It's a bit of a strange step for her. I'm surprised that they're doing it, but I think the Fed would manage. There's certainly a lot of qualified candidates that could take that spot if she decided to move.
Let's pick up on the commentary of Lyle Brainerd, the Fed Vice Chair. She's talking about the cumulative tightening, the bill, so to speak, for the tightening that's already in the pie. Can we talk about that just a little bit? There's two competing forces right now, Greg. On the one side, you've got sub-50 PMIs. On the other side, you've got jobless claims of 190,000. What do you put more weight on?
Right now, I think we probably put the weight on the jobless claims. I mean, ultimately, there's really a lot of consensus about where we end up, say, in 2024. Both the Summary of Economics projections and the forward markets are saying we're going to get Fed funds down to 3%. It's really just a battle about the trajectory, whether that happens with a pivot beginning in June, July, or the Fed's put a lot of credibility on saying they're not going to do that until 2024. We're a believer more in the Fed, thinking that they'd like to get to 4 3/4 to 5, do that perhaps in the March meeting. May is still open, and then really sit tight for 2 or 3 quarters. They've put a lot of credibility on the line on that, and I think they have to push it through.
Just on the labor market, you said don't confuse tech layoffs with softer labor markets. Why is that, Greg?
There's still a lot of demand, I think, in the Main Street part of America, whether it be services, your barbers, your garbage collectors, your landscape people. Corporate America is obviously laying off, but it's been limited so far. I think a lot of the tech workers are going to be able to find jobs elsewhere. And I also think that it's really hitting the bottom now, that corporate America has really been very well prepared for this recession. This is the most well-signaled recession we've ever had, if indeed we have it. This is the first time we've actually had a recovery in the markets before the recession that seems to be associated with it has even begun. So I think there's limited downside to that degree. I think corporate is still hoarding their workers to some degree. So I don't see a lot of downside in terms of the labor markets, at least over the next 3 to 6 months.
With that in mind, Greg, shouldn't you be super long the credit market?
We're fairly comfortable with the credit market overall, as strange as that sounds. Things have richened a lot since the beginning of the year. We're in 20 to 25 basis points in IG, over 100 since October, and a high yield. They're pretty much priced the way they've been on average over the past 10 years. We don't see the kind of recession that's going to really gap out spreads overall. We've seen a lot of strength in the past month or so, and think that will probably continue. It goes back to what I was saying before. Corporate America, their financial health is quite strong. We're going to see a little bit of caution in the guidance as we see earnings coming through over the next week or 2 or 3, but nobody's signaling a deep recession, and I think they're quite well prepared for the storm if indeed it comes.
Can I finish with this call from Citi in the last 24 hours, Greg, and get your reaction to it? Citigroup said this, the CCC spree, that was the title of this note. We flip our rating for regular weight CCCs to overweight due to light investor positioning, loosening financial conditions, and the shifting composition of the segment away from cyclical sectors. Greg, how do you react to that?
I tend to agree. I think the CCCs have had a remarkable rally since the beginning of the year. I think a lot of it's just a risk grab. If you need to get risk in the high yield space, of course, that's where you want to go. But that area, I think, is the one that's going to be most vulnerable if indeed we get some slowing. Obviously, increase in interest rates for floating rate debt is going to cause some problems there. It's really not going to be, I would call, broadly across the CCCs. It's more idiosyncratic, but there are going to be some names that are going to suffer, and you have to really pick your spots very, very carefully within that very vulnerable space.
Greg Staples at DWS, the first couple of weeks felt like a risk grab. Not right now. Greg, thank you. Right now, about 22 minutes into this session, we're lower by 1.2% on the S&P and the Nasdaq. We're down by 1.8%. To lift the lid on the index, to get you some sector price action, here's Abby.
Hey, John. Well, yes, it's certainly a down day here. That S&P 500, as you mentioned, down 1.2% on above average volume, too, suggesting the sellers right now are serious about their selling. Up top, we have healthcare, defensive sector outperforming, staples up there as well. On bottom, though, not surprisingly, it's all about technology. Microsoft right now, near session lows, down 4%. Technology, therefore, is down 2%. Some of the other big techs, such as Apple, Amazon, Google, Tesla, selling off in sympathy with that quarter and that cloud guide. We also have Texas Instruments near session lows, down 2%, dragging. Let's stick with the chips, because, of course, we have this huge rally for the chips out of what could be an October low, up more than 40%. But over the last year or so, John, 13 months, down 29%. The question is that sideways trend that is developing. That's a real battle between the bulls and the bears. As for what's ahead, what direction will it break? Up or down? We don't know yet, but right now we do have the stocks down with the broader markets.
The broader markets right now down 2, as you indicate, Abby. Thank you. We're down by 1.2% on the S&P and the Nasdaq, down by about 2 percentage points. Up next on this program, your trading diary.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody's talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
Not a fantastic start to the morning, that's for sure. For the equity bulls, at least. On the S&P, we're down by 1.3%. On the Nasdaq, we're down by more than 2 percentage points. Microsoft helping to lead the losses here, in the early part of the session at least. Let's get the trading diary for you. A rate decision from the Bank of Canada coming up at the top of the hour. President Biden discussing support for Ukraine at noon Eastern. Look out for that. Plus earnings from Tesla and IBM after the close. US fourth quarter GDP and another round of jobless claims coming up on Thursday. And finally, PCE numbers and the UMich sentiment survey to round out the week on Friday. From the City of London, that does it for me. For our audience worldwide, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
We have only 8% of the ocean protected today. And our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least, 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
News breaks. No one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close. Welcome to Bloomberg Crypto.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Weinergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there, like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is, when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and, well, space is really big. And then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
This is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions want them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that They're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed Harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest flight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
refer to the dictionary also, okay, and find out the new meanings. As well as you're going to describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be in the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, we say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into a medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, She came to the Gauridoddi campus and then she toiled very hard for 1 year despite many problems. And today I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students so that whoever is interested in whatever activity they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. And there were in those days I'm talking about. So the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again try to excel in academics day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition center, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well, and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like, I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
You need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. One, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges, or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while, and I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Thea and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G. And it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice. Nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology. And live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。
不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高。但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
没有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him there's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. and they add it in a chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers. And it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaxi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?